Flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
First up, U.S. stock futures pulling back today after nearing record highs following 3 consecutive days of gains. The S&P 500 closed on the brink of record, propelled by optimism over artificial intelligence spending and strong earnings. Mega-cap tech stocks got a boost on Wednesday following Trump's AI announcement, but investors are still weighing the risk of tariffs on major trading partners.
Plus, President Trump set to speak at Davos this morning. World leaders will hear from the new commander-in-chief virtually as he chats with the president of the World Economic Forum. Trump will then answer questions from major executives. Those include the CEOs of Bank of America, Blackstone, as well as the chair of Santander.
And American Airlines forecasting a first quarter loss of up to 40 cents per share in its earnings report. All that projection coming in contrary to analyst expectations of a 1-cent profit. The pessimistic outlook comes amid more bullish numbers from rivals United and Delta, who pointed to strong demand for higher domestic ticket prices and winter trips to Europe. Meanwhile, GE exceeded Wall Street expectations for profit and sales in the final months of the year as jet engine maker worked through the supply chain limitations and capitalized on strong maintenance backlog. President Trump is heading to Davos virtually. Trump is expected to address the World Economic Forum via video link from Washington, D.C. at 11 a.m. Eastern Time. Jennifer Schonberger joins us live from Davos, Switzerland. Jennifer, bundled up out there. What can we expect today?
Well, not bundled up right now, Brad. The sun's quite strong now. It's a welcome surprise. But yes, fresh off his inauguration, President Trump set to address the World Economic Forum here in Davos in just a couple hours' time. His first time since returning to the White House, just as his conference is scheduled to be winding down. The president set to address the forum via video from Washington rather than in person. After remarks, he will take questions from major executives, including Bank of America CEO Brian Moynihan, Blackstone CEO Steve Schwarzman, Klaus Schwab, the founder of the World Economic Forum, as well as chief executives from Banco Santander and French energy company Total Energies. Both Schwarzman and Moynihan extended their trips so they could participate in this Q&A with the president. All eyes in the international community will be on what Trump says about tariffs and trade. And this morning, we have been hearing from a slew of global policymakers on that front. The EU's Commissioner for Economy and Productivity said this morning, quote, "It's very important that democracies work together. And so it is with this spirit of cooperation which we are approaching the new Trump administration. Certainly we'll be seeking engagement and a dialogue with the Trump administration and find a constructive way forward." When asked about tariffs this morning, the general director of the World Trade Organization told officials from China to Brazil, quote, "Can we just chill?" The WTO director underscored that if tariffs are a negotiating tool, then let's take a deep breath and actually see if these tariffs actually happen. Though she did warn if there is tit-for-tat retaliation, that could result in double-digit GDP losses. And in fact, this morning, the World Economic Forum out with a brand new report saying that global fragmentation could decrease global GDP by $5.7 trillion, or about 5% in a high fragmentation scenario. Just to put that in perspective, that would be greater than the impact of COVID as well as the financial 2008 crisis. Meanwhile, we did hear from a member of the People's Bank of China who said this morning that, quote, "If the U.S. and China can work together, I think the Chinese will be happy to invest in the United States, but tariffs will not do it." He went on to say, "I believe Trump will understand he can open the door for both countries to work together. We hope both sides will be able to sit down and cut a deal." Earlier this week, China's vice premier said, "Protectionism leads nowhere. Trade wars have no winners." Guys.
All right, Jennifer, thanks so much for breaking that down. Yahoo Finance will bring you President Trump's speech that's expected to be live today at 11 a.m. Eastern Time. President Trump's scheduled remarks coming a day after he threatened Russia with fresh tariffs and sanctions if a deal is not made soon to end its war in Ukraine. Eddie Fishman, he's a senior research scholar at Columbia University's Center of Global Energy Policy, author of Choke Points, American Power in the Age of Economic Warfare, also a former State Department official, joining us now. Eddie, it's great to have you here. Let's talk about just how effective, or maybe the approach that we've heard so far from President Trump. Just given your experience, what has worked, what hasn't worked, specifically with Russia, what do you make of his approach this time around?
So look, I think, Shauna, there were a lot of expectations in the markets, in the diplomatic community, that Trump might come in and lift sanctions on Russia absent any significant change in Putin's policy in Ukraine. And I think there was a lot of concern around this because Russia's economy is reeling. So it seems like there's a real opportunity to turn the pressure up on Russia and potentially get Putin to negotiate a just peace in Ukraine. So I think the comments that Trump made yesterday, which signaled that he might actually even increase sanctions on Russia if Putin doesn't end the war, were a really important signal and probably makes it more likely that Putin doesn't think he can just wait out the Trump administration and get everything he wants in Ukraine.
With that in mind, it wouldn't also, though, mean that there'd be more funding that would go to Ukraine, from our understanding, right?
Brad, that's a very important point. I mean, sanctions and aid to Ukraine are sort of two sides of one strategy, right? The sanctions on Russia are the leverage to get Putin to the table. The aid to Ukraine is absolutely critical to allow Ukraine to continue to defend its country. So I think that you're touching on an important tension. It'll be very important to see in the next few weeks if there's a signal out of the Trump administration whether they're going to continue backing Ukraine militarily. Because I think if there is a cutoff in aid to Ukraine, Putin might just say, you know what, these sanctions, they're really bad for my economy, but if I can stick it out for a few more months, I might be able to roll over Ukraine and get everything I want in that country.
What's the efficacy, though, of these threats, just given the fact that the trade relationship between the U.S. and Russia is a fraction of what it used to be?
So tariffs don't make any sense on Russia because, we only have about $2 billion in bilateral trade right now. But with Trump, you have to realize that when he's saying tariffs, sanctions, export controls, he really just means one thing. It's economic coercion. And he did include the word sanctions in his comments. So I think were the U.S. to increase pressure on Russia, it wouldn't really be through tariffs, it would be through sanctions. And in that regard, there's quite a lot left to do in terms of sanctioning Russia, in particular, the oil sector. So the largest oil company in Russia, Rosneft, is not yet sanctioned. Neither is the second largest oil company in Russia, Lukoil. So I think there's an opportunity, perhaps, for the Trump administration to sanction, turn up some of the heat on Russia's oil sector, potentially also creating room for American oil producers to increase production, which is another goal of the new administration.
With regard to some of the early calculus that we're seeing run by some of the largest names on Wall Street, Jamie Dimon, for instance, around tariffs, and I imagine they're also evaluating in the holistic of the geopolitical tensions, whether that be with Russia or whether that be with China, whether or not this is going to be more inflationary. And it sounds like from Jamie Dimon's perspective, he's saying, hey, if we get more U.S. security, then all right, so be it. Bring on the tariffs, even if inflationary for a period of time. I wonder how you're evaluating this.
Look, we are living in an age of economic warfare. Sanctions, tariffs, export controls, they're just how great powers compete today. So I don't think what President Trump is doing, while I think it's untraditional in terms of the way he's making off-the-cuff threats and blanket tariffs, there has been a secular trend over the last 2 decades in U.S. foreign policy of using these tools more often because we've seen greater geopolitical competition. And I think that what Jamie Dimon's comments, I think, reflect are that, there are sometimes trade-offs between our economic growth, our economic, security at home, as well as our national security. And I think that, those trade-offs are real. And it's possible that I think if Trump does go forward, especially with his more aggressive tariff threats, that you will see resumed inflation. And I would just hope that there'd be a good justification for it.
Eddie, do you think the approach is going to be maybe a bit more structured than what the markets initially feared?
It's a good question. I mean, if you look at Trump's day one executive order on trade, it did actually imply a fairly structured process, right? Where there's a series of evaluations that are going to be done by the Treasury Department, by the Office of the U.S. Trade Representative, by the Commerce Department that are all due on April 1st that evaluate everything from the U.S. trade deficit to the use of export controls to prevent critical technologies from getting to China. So if you just sort of look at the letter of Trump's actual actions, they do suggest actually a more structured process. But then, of course, Trump has made these off-the-cuff remarks saying that he may impose 25% tariffs on Canada and Mexico by February 1st, or he may impose 10% tariffs on China, or maybe even tariffs on the European Union. So I think it's very difficult to evaluate. And of course, he doesn't even have his senior economic team confirmed and fully in place yet. So I think we'll know a lot more in the next week or two. I think if he does pull the trigger on some of these tariffs on February 1st and potentially uses novel legal justifications for them, I think we are in for a much more wild ride than many expect. But I think if those threats don't come to fruition, and we do kind of see this more structured process leading up to April 1st, which is what is suggested by the executive order, then I think that is a sign that there will be a little bit more structure and process behind Trump's economic war.
And Eddie, when we talk about the significance of the post yesterday and directly speaking to what could potentially happen between the relationship of U.S. and Russia, there weren't many deals, if any, really struck between the two leaders the first time around during Trump's first administration. Do you see that at all changing this time around?
Look, I mean, it really comes down to two things. One is Trump willing to actually stand by Ukraine's sovereignty and territorial integrity, which will mean continuing to provide significant aid to Ukraine. Although I will add a caveat there that there are, almost $300 billion of Russia's sovereign reserves sitting in U.S. and European banks that could be seized and given to Ukraine. So it's not necessarily taxpayers that'll have to pay for it. And then the second question comes down to Putin. Putin's economy is in a really tough spot. It's not going to grow at all this year. You may even have a recession. You've got really high inflation, interest rates over 20%. Russians are getting home mortgages at 30%. So the economy in Russia is doing really poorly. So the question for Putin is, at what price is he going to try to achieve his maximalist imperialist dreams in Ukraine? Hopefully, if Trump signals that pressure is not going to be alleviated absent a deal, Putin will realize that he's risking a lot more to his legacy by continuing the war than by ending it.
Just, Eddie, lastly, while we have you here, how much more complicated does this get, especially as Trump is rolling out essentially the red carpet for investments to come into the U.S., while at the same time wanting to both secure national security or put forward more of a face of national security and also be stringent about where those partnerships, especially knowing where he might layer on tariffs, where those partnerships get even more complex if you're banking on some investment coming in from a foreign counterpart and then also trying to slap tariffs on top of them as well.
Yeah, there is definitely tension and potentially incoherence in some of what Trump is saying, because I think if you did have a more rigorous definition of national security and said, look, we are not going to trade or invest in Russia because Russia is an adversary. They're directly threatening the United States and its allies. We are not going to allow advanced semiconductors to be sold to China because China is competing with the United States in the artificial intelligence race, and that's a critical competition for the U.S. to win. If we do sort of maintain that discipline, but then say, look, we can trade freely with Europe, we can trade freely with Japan, with Korea, with our allies in North America like Canada and Mexico, I think that is, a recipe for a very robust economic growth and a healthy U.S. economy. I think it becomes challenging when you're not only seeing sanctions and tariffs on the likes of China, Russia, and Iran, but also on Canada, Mexico, and the European Union. That, to me, is a recipe for a chaotic breakdown in the world economy if Trump, of course, follows through on these threats.
Eddie, thanks so much for taking the time here with us this morning. Really appreciate the insights.
Yeah, my pleasure.
President Trump downplayed TikTok's national security risk in an interview with Fox News Wednesday. And this was days after delaying the app's ban in the U.S. via executive order. Trump asked interviewer Sean Hannity, is it that important for China to be spying on young people, on young kids, watching crazy videos, end quote. Adding many other electronics that could be used for spying are manufactured in China. Now, TikTok has repeatedly denied that it turns over user data to Chinese officials. U.S. lawmakers argue otherwise. Trump previously tried to shut down the app back in 2020. Now his tune has changed. When asked what was behind his pivot, he told reporters, I got to use it. China has also indicated that it's more open to a deal over TikTok's U.S. assets, and several would-be buyers have emerged, including Elon Musk, Larry Ellison, and YouTuber Mr. Beast.
Beyond China, foreign policy interests in the Middle East have certainly been something that investors have been closely watching since Trump's inauguration. Saudi Arabia's crown prince telling President Trump that he plans to invest $600 billion in the U.S. The plan was reportedly discussed during a phone call between the two leaders. The comments coming after President Trump talked about possibly returning to Saudi Arabia for his first foreign trip for a price.
I did it with Saudi Arabia last time because they agreed to buy $450 billion worth of our product. I said, I'll do it, but you have to buy American product, and they agreed to do that. They bought $450 billion. If Saudi Arabia wanted to buy another $450 or $500, we'll up it for all the inflation.
Historically, U.S. presidents visit the United Kingdom as their first overseas trip, but President Trump broke with that tradition back in 2017, instead traveling to Saudi Arabia. It's not yet clear where the Saudi $600 billion investment will be placed, but Saudi's sovereign wealth funds have recently taken large stakes in a number of American businesses and sports investments. Coming up ahead on a morning brief, we're going to count you down to the opening bell on Wall Street. Plus, we break down the surprise loss American Air posted in its earnings. We've got a sell-off resuming in Treasuries with yields creeping higher once again today. Will that continue? We'll discuss that and much more coming up on Morning.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Shares of American Airlines falling after its first quarter outlook came in short of Wall Street's expectations. While the carrier reported record revenue in the fourth quarter and full year of 2024, American Airlines anticipates a loss between 20 and 40 cents per share in the first 3 months of 2025, driven by lower capacity. For more on American Airlines and the airline sector results that we've seen so far, let's bring in George Ferguson, who is the Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Industry Analyst. Thanks for joining us here before the open and after these results. We now have Delta, we've got American Airlines and United Airlines here. I mean, if you were to look through these results, what grade would you be giving American Airlines compared to some of the other industry counterparts?
Yeah, so I mean, I think if you give United and Delta an A, you'd give an American a B maybe, right? So American is catching up. I think their yield performance, price paid per mile flown, was very good for all the markets. It looked as good as, if not better, than United and Delta. And so they had made a stumble in the last couple of years as they were trying to go to more direct bookings, directly through American rather than through the travel agencies. They've changed that strategy. They're back to taking travel agency bookings and going out to corporate customers and try to redo some of their agreements with them. So on the revenue side, they look pretty good. And look, they did about the same as most of the other carriers on. They drove some good profitability with lower fuel prices. Again, I think the market's a bit spooked by the first quarter guide, and it's all about lower capacity means higher costs. And so they're going to come in at a loss. It's a little bit strange compared to the other two, but they say they're going to catch up over the year. And again, I think they are improving and closing the gap with United and Delta.
Yeah, George, I guess the question is what that catch-up rate looks like. I guess how confident are you that they can catch up to the leaders right now, what we see when you compare it to the results that we got from United when you compared to Delta, that they're going to be able to do that in a very timely fashion?
So I think they'll be able to catch up. It'll take time, right? I think you're probably looking across a year. I think just one really interesting note is, when you look at Delta and you look at the strength of their loyalty program, they're on track for $8 billion this year. American showed us a loyalty program, I think about $6 billion over 2024, won't grow to $8 billion this year. Just an example of one of the challenges they have as they try to recover and become closer to best in class. So not going to happen over a couple of quarters. Take a year or so, but they are closing the gap.
For the revenue performance side, it still was a record fourth quarter revenue period for the company. I wonder, from the investments that you're anticipating to continue to come forward from American, whether that be on fleet and capacity or whether that be on trying to capture some of the premium that spills over from Delta and from United Airlines as they've made their own investments, how you expect some of that capital to be really invested back into the experience and for them to prove that through to investors through some of the margins going forward.
Yeah, so American is, I think, ahead of Delta and definitely United on fleet refresh. They had done it previous to the pandemic. They were deep in the middle of it. They were one of the, they were and are one of the more highly levered U.S. airlines. So I would, they even said on the call they're not going to have as much fleet buying activity in 2025. That helps their cash flow that they can use to pay down debt. So it'll take some time to return that to shareholders, but I think they're in sort of pay down debt mode rather than improve or increase refresh fleet mode, which is, again, another one of the positives in American. Just they're managing a lot of debt in the balance sheet and focuses on paying that down because they were early in that process.
George, when it comes to the Trump administration, we were asking Mike Boyd this yesterday. We asked the CEO of Southwest, Bob Jordan, this not too long ago, just about the implications here for the airline industry and whether or not this lighter regulation touch, how big of a catalyst that's going to be for some of these airline leaders. Where do you stand?
Yeah, so I mean, I think the Trump administration, I think you're speaking to sort of the ability to merge airlines. And if that's what you're talking about, I don't see a lot of that activity at the higher, on the larger airline side, right? United, American, Delta, Southwest, I don't see them having any potential to merge with competitors in the marketplace. At the lower end, I think a JetBlue Spirit merger could go through. Or purchase could go through in the Trump administration. I also think as long as the Trump administration has policies that keep the dollar strong, That's right now. That's really helping to drive the big full service carriers. We're seeing just a lot of demand, especially travel into Europe, which is really helping their their performance. So to the extent the administration is keeping the dollar strong, that could be a benefit as well.
All right, George Ferguson, always great to get your insight. Thanks so much for joining us here this morning. Trending ticker that we're watching here is GE Aerospace. It beat fourth quarter profit and revenue expectations, boosted by some strong demand for parts of their business. CEO Larry Culp saying that the results, quote, capped off a monumental first year as a standalone company. The jet engine maker also issuing an upbeat outlook for the full year, announcing plans for a $7 billion stock buyback. That's adding to this risk on sentiment that we certainly are seeing, or positivity around the stock today. You're looking at shares up just about 7%. Digging into this report and what we're learning here from GE Aerospace, obviously very positive here for the quarter. You talk about the fact that persistent shortages of new aircraft, that is really driving up demand here for its higher margin parts and services business. That has been a theme and what we have seen from so many analysts here, just in terms of their expectations heading into this earnings season. So GE Aerospace very much validating that and some of the trends, strong trends that we are seeing within the industry. And Bob, when I took a look at some of the quick reaction from analysts here this morning, obviously very optimistic from some of the numbers that we saw. RBC also out saying that they actually believe investors are likely to view the free cash flow outlook as positive, and they believe that they could actually see some upside here to the margin outlook from here. So again, we could potentially see even more momentum than what is currently being priced in.
Yeah, absolutely here. They say looking to 2025, Larry Culp, the CEO of GE Aerospace and the chairman as well here, saying that they expect that double-digit revenue growth, EPS growth with greater than 100% free cash flow conversion. And this all ties back to the flight deck plan that they had put out there beginning of, and I think it was second quarter of last year, some of the guiding principles around that, just looking at making sure they're kind of driving this continuous improvement. They call it Kaizen, multi-day event, of course, where they had really kind of looked across how the business could make sure that it could have this proprietary lean operating model here to try and run the business, delivering some of the value back to shareholders as well as to those customers that they talked about when they were accelerating this lean progress here. And so I think at the onset, there was a lot of question marks around how much cost they were trying to take out of the systems in the thrust forward to that lean progress and lean production as well. And some of that's starting to pay dividends as of right now.
Yeah, certainly. Again, you're looking at GE Aerospace shares moving to the upside here just ahead of the open, looking at gains on track to open up just about 7%. Well, coming up, we've got the opening bell on Wall Street. Again, you're looking at a potentially mixed picture here at the open. Dow futures on track to open the day in the green, but looking at losses here from the S&P and Nasdaq. We'll see whether or not that holds into the opening bell. We've got that for you in just a few minutes.
That is the opening bell. Let's take a look at the NYSE, where we've got our bell ringer for today up on the podium. And then additionally, you've got at the Nasdaq opening bell a live shot of some funfetti to begin today's trading session. All right, let's see exactly where things open up at the opening cross here on the day. You've got the Dow Jones Industrial Average right now above 44,000. We're sitting flat, just barely to the upside as of this juncture to begin today's trading activity. The Nasdaq Composite, you're seeing that higher. We're lower right now by about 0.5% higher, still holding on to gains over the course of course, we're in the early throes of 2025, but we've got the year-to-date chart for you. We've added on by about 3% there. And the S&P 500, you're seeing that right now move lower just by a fraction, by about 0.2% here. But again, we were continuing to keep a close eye on some of those records that we were in the stone's throw or notching yesterday, intraday as well here. So continuing to keep close tabs on where we move after yesterday's activity. Let's take a look at the S&P 500, 11 sectors. We've got them pulled up here for you on the screen so you don't have to do the work at home. Energy leading the pack. Bringing up the caboose, technology right now. That's down by about 0.8% for XLK. Speaking of technology, let's blind you with science for a hot second here. Taking a look at NVIDIA right now, that's lower by about 1.4%, 1.5% to begin today's trading activity. Apple, you're seeing some fractional gains there. Meta, Facebook, as you might know them, or Instagram, whichever of the family of apps you use, call yourself higher by about 0.4%. And then additionally here, let's just ride out with a quick look at the Dow 30 components here. It looks pretty split here on the day, just from my best gander here, but there you're seeing we do look like we actually have a few more gainers than laggards as of right now. NVIDIA pulling up the caboose. United Health looks like it's leading the pack as of this juncture. It's up by about 1.9%. For more of a deeper dive into the context going into today's trading activity and for what to watch, let's bring in Yahoo Finance's Jared Blickery for a look at what's moving.
Thank you, Brad. Here's some context. We are looking at the S&P 500 coming off of a record intraday high, but it was not able to secure a record closing high. And in fact, we had the Dow, Nasdaq, and S&P up 3 days in a row. Looks like we're giving back some territory today. Just checking in on the Dow real quick, because that's the only major in the green, up a whopping 12 basis points. And I wanted to check in on the bond market real quickly, because the 10-year T-note is heading up today. We've seen a decline for a bit of time. Here's the 3-month chart, and you can see it is still not back up to those highs. So that's not in an area that we would consider it pressuring risk markets right now. We can also take a look at the US dollar index. That's not doing a whole lot today, so not really any pressure from there either. And let's check out the sector action once more. Tech leading to the downside. Tech is something else that almost notched a record high on the close yesterday, but just barely missed it. So a little bit of disappointment there. But semiconductors, very similar story. They're down today, but they were flying from a 5-month high yesterday. Here's the Nasdaq 100. Wanted to point out Meta, which is up 4 days straight now. And we can see on this chart up about 1.65, or now it's down 1/3% today. Had been up several days in a row. We can also check on Apple, which is up 1% today. Now that stock recently hit the 200-day moving average, and so that's a key level that technical traders look at. A bounce from there is considered healthy. We'll have to see if that holds. So $220 on Apple is what I'm looking at here. And I'll close with a look at Bitcoin. Bitcoin holding 100,000, although it's down about 1.4%. Guys?
All right, Jared, thanks. It's time now for today's strategy session. Taking a look at the bond market, Treasury yields are rising. The 10-year yield hitting 1-week highs as the stock market takes a bit of a breather. Got investors anticipating President Trump's address at the World Economic Forum in Davos, Switzerland. That's getting underway at 11 a.m. Eastern time today. They're going to be looking for a little bit more information or any insight on tariff plans and some of his other policies. Let's talk about the impact that this could all have on the bond market. For that, we want to bring in Steve Booth. He is the head of global investment grade fixed income at T. Rowe Price. And Steve, it's great to have you here on Yahoo Finance. So certainly much of the attention from the market has been one on the economic resilience and obviously the Fed's path forward. But then on the other hand, Trump policies has very much been in the driver's seat here over the last several trading days. I'm curious what you think this all means here for the bond market. We have seen the steady climb higher, to say the least, in yields. Are we heading back towards that 5% level?
Sure, and thanks for having me, and good morning. Short answer is yes. We actually do believe that we are going to retest recent highs in the bond market. Setting aside the policy dynamics, the reality is that inflation is heading higher. Inflation, in our view, as we trend into the middle part of the year, We think the risk is that it's closer to 4% as opposed to the policy target of 2%. This in and of itself will put pressure on bond yields, upward pressure on bond yields. Then you marry that with policy risk. This to us just adds up to bond market volatility. This will persist.
And so how high do you think we could eventually scratch or continue to go with this type of trend line that we've been tracking?
Sure. It's, putting a target on the bond market is sort of obviously an extremely difficult exercise. What I would suggest is that based off of what we know now, based off of the inflation dynamics, based off of the potential policy mix, retesting that 5% area on the 10-year is not out of question.
Steve, when it comes to, I guess, the biggest drivers or what is going to ultimately get us there, when it comes to, there hasn't been as much talk maybe lately over the last couple of days about Fed policy and what that is going to look like there going forward. I'm curious what your base case is right now for what the Fed is likely to do here over its next several meetings.
So I think we need to separate that into multiple time horizons. I think in the shorter term, consensus is more or less correct. We likely get one more cut at some point over the next 1 to 2 meetings. Our concern is more in the back half of the year. If our view around inflation pressures building proves to be correct, the Fed will ultimately be forced to pivot, right? And to be clear, I'm not suggesting that our base case is that hikes get priced back into the market, but it is a condition and a probability that we need to be very mindful of.
And so that probability, as you're kind of gaming out, especially the markets right now, are essentially pricing in 2 Fed cuts and really, if we were to see 2 back half of this year, if we were to only see 1, what would the Fed need to see in the data, and then what would the reaction, you believe, be in Treasury yields?
If for the Fed to only cut once or potentially be done with the cutting cycle, it's very simple. It comes down to inflation. If our views around inflation prove to be correct, and again, we see an upward bias in inflation pressures over the next 2 to 3 quarters, that'll introduce conditions where the Fed will be forced to pause their cutting cycle, and the market at that point will likely be pricing in hikes.
Steve, the potential for the 6% level in a note that your team put out not too long ago really garnered a lot of media attention. Lay out that scenario and not so much how likely it is, but what would then likely drive us to that level?
I think there's a lot of debate, appropriately so, and discussion around the Trump administration policy set. What we're really focused on is the sequencing of the policy set. If we get front-loaded fiscal stimulus, if we sort of front-run, tax policy, deregulatory policy, all the things that ultimately prove to be stimulative, those are conditions where you exceed 5% and potentially reach that 6% area. The counterpoint to that is that there is potential for fiscal tightening, right? It's a low probability event. But in the event that we get more tightening fiscal policy, that obviously would introduce a risk to our view. But our guidance here and our expectation here is really just to focus on the policy sequencing and the mix, as opposed to trying to time it.
So would it be tax cuts or would it be tariffs that would have the larger, perhaps, kind of net impact to yields from this juncture, if we were to track towards that 6%?
Sure. If we front load tax cuts and front load easing in fiscal policy, that gets you to that 6% target much more rapidly. If we reverse the order, if we end up with tariffs first and then potentially fiscal stimulus later, that introduces some risk to higher yields. Again, I really want to emphasize that it's about the sequencing of policy. We can sit here, we can track headlines, we can, we can sort of chase the latest narrative. What we're really focused on is the sequencing of policy. And if you get the stimulus first, that introduces an upward bias to yields.
All right, we're going to be tracking this closely, as we know you and your team will as well. Steve Booth, thanks so much for taking the time here.
Thank you.
It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills. Following the Trump bump in the big tech industry yesterday, what's next for the sector? I feel like I just said the Facebook when I said the big tech. Anyway, Maddie, take it away.
That's exactly right, Brad. So taking a look at the big tech sector and specifically those magnificent 7 names, following that announcement of the $100 billion investment into that Stargate venture, we did see a huge lift to the upside in all of the chip stocks, including the Mag 7 names, coming off of those highs a little bit in today's trade. So what is next for the tech sector following that bump? Well, the next big test, of course, is going to be earnings, kicking off on January 29th for the likes of Tesla, Microsoft, and Meta, all three of those big names set to report. So I want to look at Magnificent Seven growth estimates moving forward. And as you can see here, the green bar on the screen behind me represents the Mag 7 names. And you can see that profit growth is expected to slow down according to analyst estimates. We are seeing a slight lift in this white bar here behind me. That is the stock market minus those Mag 7 names, so the forgotten 493. And there is an expectation of a slight lift to those 493 moving forward, but it's not going to match the growth that we have obviously seen in the Mag 7. So what does that tell us about positioning? Maybe you can't rest on your Mag 7 laurels as much moving forward, but of course there are a slew of other potential tailwinds for those 7 names moving forward, and next week will be the true test of what this quarter is going to look like for them.
Certainly will be. All right, Maddie, great stuff. Thanks. Let's take a look at shares of Warner Brothers Discovery. Looking at slight gains here this morning, up just about 0.5%. And now this coming as CNN announced that it's cutting 6% of its workforce. That's about 200 employees Thursday, as the cable news network focuses on streaming and digital audiences amid declining ratings. Here with the details, we want to bring in Alexandra Canal. And Ali, when you take a look at this, not necessarily a huge surprise, but giving us a bit more clarity in terms of the direction moving forward.
Yeah, huge part of this digital shift that we're seeing, CNN saying that Warner Brothers Discovery is on board. They're actually going to be investing $70 million into this new initiative. So even though we are cutting 6% of the workforce, that translates to a little over 200 employees. The company said that they will open new positions as part of that investment, and they don't expect total headcount to fall significantly this year, if at all, because of those new positions. They reiterated that this is not about cutting jobs, but rather transforming and investing into areas of growth, really modernizing the newsroom. In a memo to employees, CEO Mark Thompson said, quote, "Our objective is a simple one, to shift CNN's gravity towards the platforms and products where the audience themselves are shifting, and by doing that, to secure CNN's future as one of the world's greatest news organizations." So Thompson seems to believe that unless CNN adapts to the times, unless they have a huge presence on streaming, they're going to be in trouble, especially as it relates to some of the other broadcast traditional networks. Now, to that point, the company said that in addition to CNN, on Warner Brothers Discovery's Max streaming platform, the company is also creating a new digital subscription product in the coming months in what's been described as a TV-style version of CNN that audiences can access around the world. So yet another direct-to-consumer streaming platform. Remember that the launch of CNN Plus a few years ago did not go so hot, so I'm very curious how they're planning to launch this platform this time around. They will also be refreshing the website, CNN.com, making a major pivot into digital video, developing and launching CNN's first lifestyle-oriented digital product, and truly creating a multimedia company and premium digital ad experience. Then on the traditional side, they are refreshing their TV schedule and, like we said, having some of those new positions after we see these layoffs. So, again, Shauna, like you said, not all that surprising. We know Mark Thompson, he really wanted to shake up the news organization, but in this post-election world, now we're seeing that this huge shift to the future and this huge shift to digital, especially as this company has really struggled on the linear network side. All right, Alec, continuing to track all of the changes across media. Thanks so much. Big day for sure, and some of the restructuring that's come forward here with CNN. Guys, coming up, what Trump 2.0 means for the banking industry. We take you live to the World Economic Forum for a conversation with Stifel's chairman and CEO. That's next on Morning Brief.
We're taking a closer look at some trending tickers this morning, and we're doing these ones in 30 seconds each. Let's go. First up, Tesla, TSLA. They will increase prices on electric vehicles in Canada come February. The EV maker posting the price hikes on its Canadian website. The models S, X, and Y prices will rise by over $2,750 US, and the Model 3 prices will rise up to around $6,200 US dollars. Now, there is no note of a price change for the Cybertruck. The changes are expected February 1st.
Plus, Electronic Arts hit with 2 downgrades following disappointing prelim third quarter results. You're actually looking at losses of just about 15%. We had seen the largest intraday drop that we have seen in the stock since 2008. Now, the video game company cutting its full year net bookings outlook to a range below expectations, also announcing disappointing prelim third quarter revenue. Raymond James lowered its rating to market perform from outperform, noting that shortfalls in player engagement is, quote, concerning. We also have BMO Capital Markets also slashing its rating and price target, saying that investors will now need greater visibility into EA's upcoming release slate to regain some confidence.
And one analyst is getting more bullish on Supermicro. Loop Capital raising its price target to $40 from $35 a share. The firm sees strong potential for the company in 2025, laying out some catalysts, including client CoreWeave's data center expansion plans and NVIDIA's ramp of its Blackwell chips heading into the summer. The analyst does note that Supermicro's stock will remain volatile. Shares right now are down by about 2%. We've got much more of your markets action straight ahead. Stay tuned. You're watching Morning Brief.
Yahoo Finance on the ground at the World Economic Forum in Davos, Switzerland. Of course, at Davos, actually it wouldn't be a Davos without a big presence with AI companies, technology companies. Let's get to one of those tech companies playing in both spheres. That is HPE. Antonio Neri, CEO. Good to see you again. Feels like we're just here, but you know, it's a year later, right?
It's a year later, and always great to be here. Thank you for hosting me.
Yeah, it's. I just got off. I just moderated a panel at breakfast, and what surprised me is the pace of innovation on AI. This panel was, our discussion was on AI. Have you been surprised by how fast things are moving?
I got surprised at the beginning, right, when we kind of achieved the breakthrough with the first ChatGPT. But as we provide, a lot of the infrastructure and the services to train or inference this model, I became less surprised. I think now we are looking, what is the next big inflection point? We talk about answering questions through prompt engineering and feeding more documents to train these models. Now we're moving to more the agentic model, which is basically stitching together different agents that are good at specific tasks to basically provide an outcome out of our workflow. And now obviously the next big thing is the reasoning. And so the question is how long it takes from what we know today, which is statistical driven, answering questions on the documents we fit this model into, to more reasoning. And I think that will take a little bit of time, but the technology is there, the compute power is there, and I think it's just a matter of time to get to that outcome.
How can a company build trust into AI?
Well, I think it starts by focusing on the right governance, right, and the right principles. Even ourselves, to give an example, we have more than 200 use cases that we think with our team. 40 of them are already in production, and we continue to ideate and test. And in many cases, I call it, fail fast and improve, right? So you fail in some of the use cases, no problem, move on. But ultimately, you have to have a governance and a steering team that think about ethical principles, responsibility, sustainability, lineage of these models, where the data is coming from, the provenance of the data. And you need to create a culture around it. So I don't think it's just a matter of process, it's a matter of culture and learning and improving and moving on.
Another tech executive that I spoke to said AI may not be able to be regulated, but it could be legislated. What do you think about that?
I think that person is right. But as I always said, when there is massive technology disruption like we're seeing today, my generation's seen it all. In fact, I was reflecting the other day, all the inflection points I was able to live through, from no computers to PC, client servers, to obviously the cloud and the mobile capabilities we have today. I think this one is going fast. If you think about it, when we went through just deploying phones in homes, it took decades to get to 50 million users. ChatGPT had 50 million users in 1 month. So the ability to regulate this is very hard, but I will say the private sector has the responsibility to come to the table with the public sector, the legislation side, to provide the input so that the legislation take care of what needs to be done from a society perspective, from a country, national security perspective, at the same time making sure the advancement of these technologies are not held back, because fact of the matter is going to happen one way or the other one. We've seen it over and over.
I thought you were born during the internet boom. No?
No.
Mid 90s?
A little bit older than that.
Okay, I just wanted to get that.
Way older than that.
Just wanted to clear that up.
Yeah.
I've heard a little bit of everything on AI this year. I've heard humanoids. I saw a humanoid dog come up to me on the promenade. It was really weird. I think it was by DHL, the shipping company. Strange stuff, Antonio. But then I heard at an ADP dinner on how it really may fundamentally change jobs. Is the reality that AI is already out of control and regulators they can't do anything about it?
I'm not sure it's out of control. I think there are use cases that sometimes people want to showcase either in their own benefits to say, hey, this is the potential. But the reality is that enterprises are very smart. I spend more than 50% of my time with enterprises all over the world, and they have a very responsible approach to what they are doing. First, because they need to understand the return on investment on this technology. This technology is not cheap, it's expensive. So CFOs and CEOs have a lot to say, and also making sure that the way they do business has some sort of conduct around it. Second is that when you implement these technologies, you understand the implications to their customers and how it's impacting them. So I will say, yes, there is a lot of hype about the potential, which I do believe in the potential, but we need to funnel that potential in things that advances the enterprise or solve some of the societal challenges. And then from the consumer perspective, it's up to you to decide how much you want to consume.
Before we let you go, did you win that deal with X?
We don't comment on customers because it's a privacy issue, right? And at the same time, we want to first deliver on our commitment, then we can talk about which customer is. But I have to tell you, we have a very large mix of customers that come into us for their infrastructure needs to train on inferencing these AI models.
All right, we'll leave it there. HPE CEO Antonio Neri, good to see you as always.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you a look at the three catalysts that we're watching this hour.
First up, we break down how global investors are preparing for a trade regime under the Trump administration.
Plus, we go live on the ground to Davos to bring you the inside view from the World Economic Forum as President Trump gears up to address world leaders.
And the future of Intel still in limbo as the company searches for its next CEO. We'll bring you the contenders and who stands to benefit from the company's uncertain future. The U.S. stock market roughly shrugging off tariff concerns, but Hong Kong's market closing lower after President Donald Trump teased out tariffs on Canada, Mexico, and China, all set to start on February 1st. Investors now looking ahead to Trump's planned remarks at the World Economic Forum for potential insight into those policies. For more on the global trade reaction, we've got Jeffrey Kleintop. He's the Chief Global Investment Strategist at Charles Schwab. Jeffrey, great to speak with you. A lot to talk about when it comes to the global trade, specifically in currencies, which we're going to get to. But I want to start on where the tariff risks are accurately priced into global markets. Where do you think the risk is accurately priced versus areas of the globe that need to rethink pricing of tariff risks?
Well, I think setting aside currencies, looking at equity markets, we've certainly seen a difficult period in the fourth quarter for European equities and Chinese stocks. Those two areas are certainly in the crosshairs of the Trump administration. But Mexico and Canada have done a little bit better, and that's one of the things that's interesting. I think maybe even gains, I think every day this week in Mexican and Canadian equities, there's some potential risk there given the sizable amount of trade between those countries and the U.S., and the fact that they really haven't priced in very much there on that front. So I'd say Europe and China look a little bit better positioned heading into what could be a whole new regime for trade, whereas Mexico and Canada maybe a little bit more downside.
Jeffrey, let's talk a little bit more about your base case. Goldman was out with a new note here last night talking about the fact that they actually lowered their odds for President Trump to implement some of his more aggressive rhetoric when it comes to tariffs. What are you expecting?
Yeah, that's our view as well, is that a lot of what Trump has talked about isn't really economic policy when it comes to tariffs. It's statecraft. It's really about gaining concessions in other areas, whether it's on immigration with Canada and Mexico, whether it's on many different factors. Energy is one of the areas where I think you might want to focus on. Trump's team is very keen to lock in long-term deals for Europe and China to buy a lot more U.S. oil and gas, much more production, much more of the sales overseas to try and narrow those trade gaps. That's one area where you could see maybe an opportunity here from a sector perspective. The energy sector, actually the best performing sector so far this year, recognizing Trump's support for that sector, more about U.S. energy dominance than it is so much about tariffs.
And your estimated overall tariff rate, it seems relatively high given those tariffs that Trump has already teased out. And obviously those are different from what he said on the campaign trail. But walk me through how you're getting this projection and the impact you think it could have on the sectors you just mentioned, but also kind of the macro level.
So this is, if you add up every tariff that Trump talked about on the campaign trail, you get to a number of 26% for the U.S. average weighted tariff, up from 2.6%. That's a huge move, higher than we even saw going into the Great Depression with those Smoot-Hawley tariffs. But we don't think that's in any way likely. We think something more, maybe a net increase of somewhere between 5 and 10% in terms of the weighted average U.S. tariff. And that's something that's really quite manageable when you take a look at what it means for U.S. economic growth, exports, and imports. As a matter of fact, I think there are a number of currencies and countries around the world that are braced for a far more negative outcome than so far, I think, what we're likely to see. Remember, back in May, I think it was May of 2019, Trump talked about imposing a 25% tariff on Mexico, but he never did because Mexico came forth and put forth some efforts to secure the border. And that's the exact same type of thing Trump's looking for this time. Trump also cut a big phase one trade deal with China. He renegotiated the USMCA with Canada and Mexico, and even renegotiated trade deals with Japan and South Korea. So I think he could make some deals, something we didn't see under the Biden administration.
Jeffrey, in terms of what you're expecting and what's been priced into the market, very much argument has been made time and time again that the markets are very much going to be used almost as a check here for President Trump and his administration, just in terms of the policies and what is going to be implemented here. Is the market, though, still a bit too optimistic about how the tariff playbook is going to play out?
I think there's a sense of relief that big tariffs weren't actually implemented on day one. But it's still early, and the honeymoon could end soon. Again, I'm focusing on those areas that can be better positioned, like energy, with regard to Trump than necessarily some of those areas. Look, we've seen stocks come down. I think yesterday we saw stocks like that have a lot of China sales, like Starbucks, like Skechers, like GM, like Tesla, really suffer a little bit. They pulled back on the idea that Trump is quite serious about an additional 10% tariff on China. And of course, China would likely respond in kind. So there is some risk to some of these stocks, and some of them have been high flyers. They are at risk of further developments here on the trade war front.
Let's get to those currency issues as well. We're seeing the dollar weakening versus the yen ahead of that Bank of Japan decision. It makes me wonder more broadly about whether central banks or policy from the White House are going to drive markets this year. What do you think?
Yeah, I think it's probably a bit of a shift. We're pretty much locked in on the outlook for relative central bank moves this year in terms of what the Fed, Bank of Japan, European Central Bank are likely to do. So I don't think we're going to see much of a deviation from that. Unlike last year where expectations changed dramatically, I think we're on a pretty set path with regard to the deviation in rates. So I think it really does come down to incremental changes in trade policy. Remember, the textbook reaction for a currency of a country that imposes a tariff is it for it to go up by the amount of that tariff. And we've seen that in the past. During the first Trump administration, we saw an incremental 16% new tariffs put on China, and that's exactly how much the dollar rose versus the Chinese currency. Same thing lately between the U.S. and Mexico. The Mexican currency has fallen 20% versus the dollar in anticipation of some new tariffs there. So that's actually where I think we're seeing more of the drive in currency in 2025, really around tariffs. And again, if we are getting fewer than what the market's braced for, well, that could be bad news for the dollar.
And when you think about the risks of a potential carry trade unwind, something that we saw lead to a brief sell-off in the market in 2024, how likely do you think that is this year, and is that risk priced in?
I think that the risk is relatively low. And one of the main reasons is that what we saw going into the Bank of Japan's rate hike back in late July was a big imbalance in the futures market. There was a record number of speculators betting against the yen, and they had to quickly cover those positions by selling assets in other markets. That is not the case now. Positioning in the futures market is fairly neutral. This one has been very well telegraphed. Now, that isn't to say there's still a lot of borrowing in yen that is now long into tech stocks and other things that may unwind over an extended period of time, let's say over the next several months. But I don't see a sudden reaction driven by the futures market move like we saw back in last summer. We're just not positioned the same way.
All right, Jeffrey Kleintot, thanks so much.
Thanks for having me.
Potential tariffs on China, Europe, and Mexico are expected to add pressure on retailers already grappling with a more deal-conscious consumer. Yahoo Finance has had the chance to speak with a number of retail business leaders over the last few days at the World Economic Forum in Davos, Switzerland. Here's what they've had to say about the potential implications of tariffs.
In the first Trump administration, we saw the first wave of tariffs, and we reduced our China exposure by 50%. We aren't waiting for the next wave of tariffs. We've been working to continue to move our product elsewhere.
We've lived with tariffs already. It's not a new concept. And we've been able to navigate that. It likely translates into higher pricing for consumers at the end, yeah.
More on this, let's bring in Simeon Siegel. He's the managing director at BMO Capital Markets. And Simeon, it's very much a wait-and-see mode, I think, right now for the markets, just in terms of what is going to happen for retailers, how they are adjusting. But from your base case scenarios, how big of a hit, how big of a challenge do you see this being for the retail landscape here over the next several quarters?
Good to see you, Sean. I was seriously thinking of coming in some outerwear just to feel like we're in Davos and not feel left out every time I see Sazi.
I'm with you.
See there, but
next time.
So, listen, I think that what we saw and what you just heard from your prior guest is there's a lot of uncertainty to your point. And I think that what's fascinating to me is tariff is something everyone wants to talk about, but tariff to the consumer is just another cost that goes into the equation. It's no different. And it is different, but it's no different than cotton or labor costs, or just if the cost to ship a good goes up. The consumer is looking at the end good. And we're talking about this very classroom-esque. We're talking about this as if we're at like a lecture in a big business school class. But at the end of the day, the consumer is either going to pay more or they're not. And so I think like we're talking a lot about which country is going to do what. But I think also what we need to think about is which product is going to do what. I think where is the consumer going to tolerate higher prices? Because if they don't, prices don't go up.
Well, then let's get into that from both an investor and a consumer perspective. Which companies are best positioned to win when it comes to that ability to increase their prices and have consumers put up with it?
So, yeah, I think that makes a lot of sense. I think that's the right way to think about it. The way we're thinking about it is there's consumer wants and there's consumer needs. So is it a staple? Is it something you need to buy? Is it milk? Is it gas? If the cost for something you need goes up, you're going to need to spend it. That's where we've seen inflation. On the other hand, within the wants, are the companies that have some control. There are companies in the want categories that are doing really well, that are selling at full price, that don't have a lot of discounts. And then there's a lot of companies in my world that don't have that luxury, that are actually seeing, after years of price hikes through the pandemic, are now seeing some pushback. And so I think, to me, I think we're going to have to look and say, okay, let's disaggregate between needs and wants. Needs are very different than the conversation, than the discretionary world that I'm looking at. But right now, if you had trouble selling your jeans at full price last week, I don't think all of a sudden tariffs are going to give you a lot of permission to go back to that consumer and say, no, we're going to add charge. I think the consumer is going to say, good luck, you can try, but I don't need your pair of denim. And if you're going to want to sell it to me, you're going to end up promoting it. And so there the question becomes, okay, for those companies that don't have that luxury of doing that, how do they approach it? They either have to absorb the cost themselves, or they need to start cutting corners and taking some quality out or finding savings elsewhere, like we would do for any other cost inflation uptick, even if it's not called tariff.
And so you have the tariff threat. You also have the rhetoric that we've heard from President Trump, and he's differed a little bit when it comes to maybe some of the things that we've heard from Scott Bessent, just in terms of the strong dollar and what ultimately the Trump administration would like to see here over the next 4 years. But that then further, I guess, complicates the picture for some of these multinational companies.
Yeah, and I think what your guest right before me pointed out, which I think makes a lot of sense, is not just the cost side for the tariffs, it's also the potential retaliation that we see on the other side for the actual revenues these businesses are going to do in those regions. And so I think, like you said, it's a multivariable game of chess here. I think what you are doing if you're a retailer is you're trying to create, or a brand, you're trying to create the most compelling product at the most compelling price to sell it to your customer. I don't think that changes one way or another. I think the nuance of figuring out how you're going to get there and what your margin is going to look like will. But I think it's still your job to go and convince. There are plenty of businesses. Sean, you and I have talked about this. There's plenty of businesses, I think, over the last year that have shown an ability to take market share. I think through COVID, it was all about clustering. It was all about, are things good or are things bad? And we looked at it from this high level. It was all about the macro. But over the last year, you watched LVMH and Kering tell you luxury was problematic, and Hermes and Prada tell you it was great. You watched Adidas and Nike tell you that it was problematic, and Hoka and On tell you it was great. Coach did great, Kors did not. Like, you have these runs across every subsector, and that just means companies are doing their job. And I think that's where we are. And so my suggestion, for what it's worth, I think, like, listen, there's going to be, assuming this goes through, so we have to play through what the numbers actually are, that will be something the companies are going to have to deal with on the want side, dramatically more than the consumers are going to have to deal with. Because at the end of the day, inflation is judged by what the consumer is willing to spend, not what the cost actually goes up. So if they're not willing to buy that product, inflation never ticks up.
So which specific retailers are best positioned to win under a tariffs regime?
I think the best part is it's the ones that are winning now. I think, so you just brought on a few people that were saying we've been looking to mitigate tariffs. We've been looking to move our product sourcing outside of China, outside of Asia. We watched a lot of them go to Mexico thinking that was going to be incredibly safe. And then look where we are. And so I think that at the end of the day, any company, very few companies that are entirely domestically sourced. That just is a very hard thing to do. And so recognizing that almost every business I look at, almost everything that we wear has some touch point done outside of the US, well, you're going to have to then say, okay, rather than which of the companies that are most and best situated to deal with the sourcing, I think it's which of the companies that are most resonating with consumers. I think at the end of the day, that's their job. The job of these companies is not to dance around the politics of what is the tariff going to be, what is it not. The job is to figure out how to make the most compelling product and how to price it accordingly. Now, obviously, the supply chain matters tremendously. We watched that happen during COVID. So the back end does matter. The cost to create that product is infinitely important. But the job of the company is to be able to get the right price for the right good to the right consumer. I oversimplifying it, but those are the companies who do that best. Those are the ones who are going to win. And I just went through we're seeing this market share, which I think is really encouraging. I think it's actually more encouraging to see divergence of performance than it is to see everyone winning. When everyone wins, you don't find out who's actually doing a good job. There's just wind at your sails. There's stimulus. There's lack of product out there because supply chain shut down at the beginning of COVID. In a real life environment, you're supposed to have winners and losers, and you're supposed to have them across the high income, across the low income, across goods, across things. It's everything. It's the whole idea of kind of, we're simplifying it. I think you want to find who's winning, who's not. Those who are winning, those who have the ability to take price, those are the ones that'll be able to continue taking price. But again, that's on the want side. The need side, the staples, that's different.
All right, Simeon, thanks so much.
Good to see you guys.
President Trump keenly focused on the performance of the stock market, but eking out gains could have more challenges under his second term. Yahoo Finance's Josh Schaefer joining us now to discuss the market under Trump 2.0. And Josh, full disclosure, I was eavesdropping on you while you were talking about this story in the newsroom yesterday and thought that we had to talk about it on the show. What are you looking at when it comes to Trump's ability to influence the market this time around?
Well, if we're going to look at Trump as the CEO of America, he figured out the button that all of the other CEOs have pressed over the last 2 years, right? Trump found the AI button. He comes out with this investment, Stargate, on his, it was really, I guess, technically the first market day that was open, but it was after hours, right? There were reports about it during hours. You started to see stocks move, but you really saw AI stocks take off yesterday, right? As investors digested this news, you saw a giant jump in ARM, a giant jump in shares of Oracle, Palantir, all the way down to Supermicro, NVIDIA, and really it was an AI rally that we haven't seen in a little bit, guys. We haven't seen anyone really kind of been able to stir up interest in AI. Well, President Trump saying that his administration is very interested in investing in the AI build out in the US. That's something that excites investors, and that's something that he can do and continue to talk about to move markets. Maddie, what I was thinking about when I sort of posed that question yesterday in the newsroom was the story I'd written last week, which was Trump might not be able to control the market under this regime in the same way he did from 2016 to 2020, because right now to us, and what we've been hearing from a lot of strategists, is interest rates are one of the key drivers of the market right now, right? And he doesn't really have a lot of control over interest rates, no matter how much he might want to have control over interest rates. That's more a question for Fed Chair Jerome Powell and the Federal Reserve. And so it seems like there's gonna be this push-pull of what sort of things can he say that could move the markets, but is interest rates going to matter more? I guess that in some ways remains to be seen a little bit at this point. It's week one here.
Yeah, and I guess also next week is going to be telling. You and I were talking about just about the slew of econ data and also earnings that are expected to be out, and then looking ahead even further to that over the next 2 weeks with the jobs report. But it could just be that actually both matter a whole lot to the market here.
Oh, for sure. And let's just think about what the news has been this week, right? What sort of news have we been digesting as investors? The Fed's in a blackout period, so we haven't heard from the central bank. Interest rates have not moved that much this week. We've had some earnings. Netflix had very strong earnings, right? Started big tech. Their earnings overall have been decent, but it's not big tech earnings like we're getting next week. So it's been a quiet week. So who's been in the driver's seat of the stock market? It has clearly been President Trump. The market action on Tuesday was, okay, we didn't get day one tariffs, dollar weaker, stocks rally. Market action on Wednesday was, let's go, AI investment, this is great, AI stocks rally, right? So it's kind of the only thing people are listening to right now. It will be very interesting next week and into the week after as we look at this potential February 1 tariff implementation, right? Next week, you have the Fed meeting, you have big tech earnings, you have a jobs report the week after. The news flow is going to pick up more, and I think we're going to start learning a lot more about how investors are actually, how much attention they're actually paying to every single move that Trump makes over the next 2 weeks than say we're making in week one. Because again, I think it's just been a little bit, normally this is one of those weeks where it feels like we just float higher and there's not a lot of news.
Yeah, and I also think it's going to be interesting when we start getting some checks just in terms of market sentiment and whether or not the market has been a little bit too optimistic when it comes to the payoff and what we could see ultimately from some of his policies surrounding tax cuts, if they're a little bit too optimistic about tariffs too, and kind of how that further gets digests here on Wall Street.
And what do the companies actually say about these policies, right? We're in the middle of earnings season. We haven't heard from about 80% of the S&P 500 executives at this point. What do they say about tariffs? What do retail CEOs say in a couple weeks about tariffs? What do all of these big tech CEOs say next week about this AI investment? You're going to start to learn a lot more about how companies are actually preparing for this and how it feeds into their guidance for the year and how they think it's going to impact profits. I think we're still in our speculative period right now, and we're going to go into getting a little bit more actual data to work with and actual commentary to work with, I think, in the weeks to come.
It'll be really interesting more long-term throughout the year, too, whether or not the market cares as much about the tariff policy once we get clarity on the Fed's path forward and what that neutral rate looks like, then what happens to Trump's ability to control the market if the neutral rate is higher than folks are anticipating right now and what investors are hoping for.
And at some point, when does the deportation story come more into focus, right? We're all talking about tariffs right now, but that also has serious implications for the overall economy and the Fed as well. And I think at some point, you're going to start to see it shift between which policies we're talking about the most.
Yeah, we're seeing more and more economists focus on that part of the story as well. All right, Josh, thanks so much. Well, coming up, we're taking a look at the latest news moving chipmaker stocks, including expectations that President Trump wants to cap chip exports to China. We'll be right back. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. All done on Yahoo Finance's trending tickers page. First up, let's take a look at shares of NVIDIA partner and memory chip maker SK Hynix. It's sliding after reporting record quarterly profit of $5.6 billion. Now, SK Hynix leadership warning of potential slowdown in chip demand for smartphones and PCs. But it did say, though, that it expects to see continued demand for its HBM, high bandwidth memory chips, which are used to train AI models. Despite some of that optimistic language surrounding the HBM business, you are looking at losses here of just about 2.5%. But remember, though, this is a stock that has seen a significant run, at least when you take a look at that 1 month chart here of SK Hynix. So a bit of a give back here this morning. I don't think too much to read into when you try to extrapolate maybe what this signals about the overall AI demand and what we are seeing play out within the market. You see that 1 month chart there up nearly 30%. It still very much points to a bullish background and bullish sentiment surrounding the AI picture and what exactly that is going to look like here. The company reporting a 20 times jump here in operating profit, 75% rise in revenue, driven by that strong demand for that high bandwidth memory chip. So again, when you take a look at that, coupling that with some of the spend expectations that we're hearing from the hyperscalers and what we're hearing from so many of these larger tech giants, I don't think it so much really changes the narrative surrounding the AI plays and some of these chip makers, at least as of yet.
Yeah, because the earnings results were great, obviously, for SK Hynix, and we did see that initial lift. So there are a couple potential explanations for the pressure we're seeing today. We were talking about whether or not the announcement of Trump's investment into AI infrastructure led to such a run-up into some of these chips earnings that we're seeing a little bit of profit taking today. Also, some news we're about to talk about in terms of export controls could potentially be weighing on the sector, especially as their results did point to such a global boom in AI demand. Maybe that's part of the story this morning. And also the fact that so much of the revenue is concentrated into those high bandwidth memory chips. Maybe there's an interest from investors in seeing a little bit more of a broadening as a way to kind of create a moat around the company in anticipation of any of those export controls or impact of tariffs moving forward and national security concerns more broadly. But I do think it has to be a positive indicator for what we might be seeing from NVIDIA down the line this earnings season. Whether the street takes it that way remains to be seen, of course, but it seems like this is indicative of strong spending over at SK Hynix. Well, we're going to shift gears to AI chip equipment maker ASML. The Dutch Prime Minister saying he expects President Trump to continue pressing for limits on ASML exports to China. The Prime Minister speaking at Davos saying, quote, "The Biden administration pushed very hard, and I expect the Trump administration pushing in the same way." So this is that national security concern that I'm talking about here, and those export controls weighing on the broader chip sector. This morning, you can see those ASML shares down about 3.5%. It points to the national security question that I'm really interested in seeing how the administration handles, because you can kind of pick and choose where the national security concerns come into play. Suddenly it's an issue for chips. It's no longer an issue for TikTok. I'm having trouble getting clarity on the broader thesis here.
Yeah, and I think many within the industry would also agree with you just in terms of what that clarity looks like, what exactly that path forward looks like. What I found so interesting about the Dutch Prime Minister's comments here over at Davos was just he very much said that the U.S. and Netherlands were aligned when it comes to the approach here and some of the national security concerns in regards to China. But he did couch it just a bit, and he did say when it does come to ASML, we currently have discussions on a weekly basis. He also reiterated the fact that he thinks it's very important that we decide on our own as to what they will do. And this was in regards to the export controls policy, saying that ASML is very important to the Dutch economy. So he did couch it a little bit, saying that it is important for obviously the Netherlands to make their own decisions and obviously have their own say and sort of influence as to how all of this plays out. But I think this is also just indicative of the uncertainty surrounding the industry at large and even beyond the U.S. when you talk about some of the U.S.'s strategic partners here and some of the influence that the U.S. is going to have in order to push that national security concern more on a global scale and ultimately the impact that's going to have on so many of these companies just beyond U.S. chip makers. And we're starting to see that play out here in the markets and some of the pressure that we have seen on some of these stocks lately.
Yeah, great point.
All right, well, U.S. chipmaker Intel still searching for a new chief executive. Former chief executive Pat Gelsinger was removed by the board this past December. Now, Yahoo Finance spoke to several company insiders and analysts who say that there are several contenders for the position, including interim co-CEO Michelle Johnston Halfhouse. Now, this comes just under a week after reports an unnamed company may be considering taking takeover talks here for Intel that initially moved the stock last week. Again, that was just reports here. Today, you're looking at losses of just about 2%. We've seen a couple of shops come out just in terms of maybe a slightly more optimistic tone when it comes to Intel and maybe what we could see here over the next several quarters. But I think the issues do remain just in terms of where they stand, their market share, their falling or their shrinking market share, just in terms of some of the traction that they've been able to gain within the AI business. But again, you have seen a name like HSBC raising its rating, just raising it to a hold rating, but basically saying that they now see limited downside. Again, though, this comes after shares have significantly dropped. And you're looking at a one-year chart right now on the screen with the stock off just about 56% over the past 52 weeks.
Yeah, and this CEO search comes amid a challenging couple of decades for Intel. If you go on the Yahoo Finance site, you can find this reporting from our colleagues here on Intel's biggest misses throughout the past 2 decades here. One of them in the early 2010s, failing to keep up with rivals on GPU development, obviously NVIDIA overtaking them by a mile here, but also turning down a stake in OpenAI, Apple rebuffing Intel, going with their own designs for chips as opposed to sticking with Intel, just a slew of some of those partnerships and clients that they weren't able to keep those relationships up with, weighing on the company's financials. So it's not just the challenge at the executive level, it's also just the balance sheet itself continuing to be under pressure. Zooming back to our conversation on the broader chip space too, I thought it was interesting, Katie Koch this morning at Davos from TCW, talking about how she sees a big risk to the market this year being that lack of U.S. domestic chips production. And in the context of that $100 billion investment from the Trump administration into AI and from a slew of different companies, I should say, how are we going to supply those chips domestically still remains a big question. And maybe that means Intel, if they can kind of get it together at the executive level, becomes a beneficiary of that. It's something that, of course, we're going to continue to monitor.
Yeah, exactly. And I think as we talk about the incoming CEO and maybe who that will be, they talk about that selection process. I think very much front of mind here for investors and even for the street is just who is going to incentivize some of the change that we've long been waiting for here. Many shareholders have been waiting for at Intel. And you talk about that turnaround process, just who will likely be able to get it done and where that focus goes here for Intel going forward and what makes the most strategic sense at this point, because clearly changes need to be made just given the underperformance here for so long.
Yeah, investors definitely looking ahead to that. Well, coming up here, AI investments. How could they impact the tech trade this year more broadly, and where should you be hedging? We'll talk about that next right here on Catalysts. Elon Musk and OpenAI CEO Sam Altman clashing over that $500 billion AI infrastructure project announced by the Trump administration. The initial $100 billion investment involves a partnership between OpenAI, SoftBank, and Oracle. It is dubbed Stargate. Musk saying on X, quote, "They don't actually have the money. SoftBank has well under $10 billion secured, and I have that on good authority." Sam Altman firing back, inviting Musk to visit the site in Texas, going on to say, quote, "This is great for the country. I realize what is great for the country isn't always what's optimal for your companies, but in your new role, I hope you'll mostly put America first." This is the latest in a years-long feud between Musk and Altman that started with a disagreement over who should run OpenAI, of which Musk was an early investor.
Meanwhile, SoftBank and OpenAI each planning to commit $19 billion to Stargate. That's according to a report from The Information. Now, the two companies would then both own 40% of the venture. Oracle and Abu Dhabi-backed MGX will each commit $7 billion, with the rest of the initial $100 billion coming from limited partners and debt financing. According to the report, Altman telling colleagues that Stargate was like a venture fund, with OpenAI and SoftBank as its general partners. Well, chip stocks today are a bit mixed. You can see that up there on your screen. Now, this comes after yesterday's rally following the news of the Stargate AI data center project announced by the Trump administration. Joining us now for the road ahead, not only for tech giants, but also for some of those chip makers, we want to bring in Rob Hayworth. He's U.S. Bank Asset Management Senior Vice President and Senior Investment Strategist of Wealth Management. Rob, let's just start right there with the tech trade. Obviously, the announcement yesterday adding to some of that risk-on excitement. Will it last?
In the long run, yes, we think it will, right? The challenge here is artificial intelligence is really still in its early stages of its investment boom. And this includes, in addition to just building the architecture itself, building out the energy needs and the energy supply needs to support this over the long run. So we think that this has a long road ahead of it. We may be a little ahead of ourselves in price. A lot depends upon what are the investments moving ahead, but we think there's room to run.
And what does that room to run then look like in terms of investor positioning? Where do you see the most opportunity for investors in specific names?
We don't really talk specific names, but obviously those that in the chip sector, right, have been early winners. We've seen some of the big technology names have significant investments. The next stage is really those income investments when it comes to the utility companies, because we really need that energy to start building out the data centers. And even though it's been a challenging couple of years here for real estate, right, data centers really are very important in this process, and there's more to come there. But then lastly, it will have to be the last mile, right? Ultimately, there are companies outside the tech industry, outside the utility industry, that have to benefit from this technology and make money from it. And so this is something we'll see that will start to work its way through the whole economy as we get to that last mile of who benefits from the usage of artificial intelligence, not just its production.
Yeah, I know you recommend a pro-growth strategy, and since you mentioned utilities, I want to jump on that. Does the utilities trade sort of become the next pro-growth, tech-ish trade in 2025, given the focus on energy to fuel AI?
Probably not as much growth as we've seen out of the tech names, partly because it's such a regulated industry as we think about it overall. But given that interest rates have moved up so much, right, we think there's room for improvement here, especially for investors to gain some of that diversification, see some of that build out and benefit from some of that growth and demand, which remains significant by all estimations relative to our current electricity usage in this country.
Rob, what do you think of earnings season so far? Obviously, we heard very, very strong results from a lot of the big banks. We're getting a look now at more of the consumer-facing companies looking ahead to next week. When it comes to big tech earnings, how big of a test is this going to be for the markets? And are you confident that we're going to clear this higher bar?
Well, certainly the early results are very good, right? We had double-digit expectations coming into this quarter for the fourth quarter results, up 11.6%, I believe, were the pre-release expectations. We're up about 12.6% on earnings right now with everything we've heard. And that's on some very strong results from the financial sector. Early technology results look good, and that could continue to benefit. And we'll have to see this broaden out. Certainly, as we look at some of the airlines, for example, that's been a bit more mixed. but it really looks like this could be a pretty solid earnings season. The key for us will really be, what picture do we get painted for the full year of 2025? Expectations are pretty robust right now for 2025 in total, about 13% year-over-year growth at this point, with S&P 500 expected earnings about 272, if I recall properly. That maybe is a little rich, but here, this will be the key, right? What is the news we get from companies about their expectations for the full year? Can the consumer continue to spend at these levels, which, based on the initial jobless claims we saw today, certainly looks like the consumer remains quite healthy, and this could be a decent year for earnings overall.
You know, Rob, I'm curious just from a strategy and strategist perspective here, when it comes to earnings and more of that fundamental picture versus some of the rhetoric and what we're seeing policy-wise coming out of DC, how do you square those two just in terms of the driving factor, or what is going to have the most influence here over the markets in the months to come?
Yeah, in the near-term months, we think it's earnings, although I think there's a very big question as to what happens when it comes to inflation and trade policy. But right now it's earnings. That remains a very, very solid component here. Over the last couple of years, we've had very strong returns for the equity markets. About half of that has been based on earnings multiple expansion. Going forward, it's going to be earnings that have to be that driver. And then the risk factor, or the opportunity factor, remains what happens with government policy. How does that further enhance the earnings outlook here, or does it start to change the opportunity set and cause some caution in the markets, which will really, it seems like, happen at the price multiple level rather than the earnings growth level.
All right, Rob, thanks so much.
Thank you.
Coming up, as earnings season kicks in a full gear, we are looking at how investors can use options to maximize returns. That's next, right here on Catalysts. Alaska Airlines, Verizon, and American Express all reporting earnings before the end of the week. And next week, some of the first big tech names are set to report, including Apple, Microsoft, and Tesla. Our next guest has recommendations for how investors could be using options during earnings season. Sean McLaughlin, All-Star Chart's chief option strategist, joins us now for an options segment sponsored by Tasty Trade. Sean, great to have you here. Just level set with me. How great does your investor hygiene have to be in order to engage in options trading during earnings season?
Well, that's an interesting way of putting it. Investor hygiene. I like that. The great thing about options trading and using options for perhaps longer term investments is that you can clearly define your risks in a way that a stock trader cannot. And at earnings season, this is incredibly important because think about this. You're long a stock heading into earnings, you're bullish, you think that the stock is going to pop. And maybe you have a stop loss order working that will take you out if the stock trades down to your price and it could get you out. Well, what happens if the earnings event happens and the next morning the stock gaps 20% lower, far below your stop loss order? The stock trader is going to get hurt dramatically in that situation because they have no out. They have to get out at the opening price the next day, which is whatever that price is, and it could be way below their stop. Meanwhile, the options trader who played that same trade, maybe just purchasing long calls, their risk is defined. They can't lose any more than what they paid for the premium of those call options. And so they're going to be in a much better position and a position of strength to ride out any volatility. Now, if they get it right, both the stock trader and the options trader are winning, but the options trader is getting better returns relative to the amount of risk they took. So for me, options is the way to play earnings.
You know, Sean, when it comes to some of the strategy behind options trading, when it comes to earnings season, is there a different strategy that should be employed, just given the fact that we are likely to see a more volatile ride for some of these stocks?
Well, there's a lot of people that like to trade earnings in a way where they put on trades right in front of the event, maybe the night, the close, right at the close before the afternoon announcement, and they will sell premium. And what they'll do is they'll sell what's called a delta neutral spread, right? They'll sell some out of the money calls, they'll sell some out of the money puts, and all they're really betting on is the collapse of the options premiums coming out of the event. Because after the event happens, assuming there's no drastic move in the stock, then the fear that priced extra premium in those options will come out, and then the seller of those options can buy them back the next day, presumably at a cheaper price. There's a lot of people that trade earnings events that way. I do not. The way I look at earnings events is I use them as a catalyst for whatever thesis I have on the underlying. So for example, we're currently long NVIDIA. We got long NVIDIA a couple of weeks ago. We're in an option spread in that. And we bought NVIDIA not because of earnings, but because we like the setup. But we saw that earnings are on the horizon coming up. And I'm using earnings as the catalyst that could continue pushing the stock higher, because the way I learned it is surprises, if you want to call them earnings surprises, they tend to happen, they tend to unfold in the direction of the underlying trend. And NVIDIA has been nothing but up, more or less, for the past year. And so odds are, if there's an earnings surprise, it's likely to be higher. And I'm positioned for that, and I'll win if we go higher. But the important part is if NVIDIA goes the other direction, I have a defined risk trade on it. I already know the most I can lose, and I'm comfortable with that. I've sized my position in a way that if I lose 100% of the premium, my portfolio is only going to lose about 1%. No big deal. I could come back from that.
You got the hedging baked in, Sean. Thank you so much for joining us. Really appreciate it.
You're welcome. Thanks for having me.
We're going to have all your markets action ahead, so stay tuned for more. You're watching Catalysts.
It's time for Yahoo Finance's Market Minute. Stocks are mixed as investors anticipate President Donald Trump's address in Davos. In individual moves, Warner Brothers Discovery shares slightly higher after CNN announced it's cutting 6% of its workforce. The company plans to pivot to streaming and digital audiences amid declining ratings in its linear network unit. WBD will invest $70 million into the revamp, creating a new streaming product and refreshing CNN's website. Plus, shares of EA sinking today after the video game maker slashed its annual forecast, sparking investor fears around sales of its popular soccer game FC 25. And GE Aerospace jumping after the company reported revenue well above expectations thanks to an influx of orders at the end of the year. The company also announced a $7 billion stock buyback program. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. More Catalyst starts now.
In just a few minutes, President Trump is expected to address the World Economic Forum via video link from Washington, D.C. Jennifer Schomburger joins us now live from Davos. And Jennifer, we're already getting some pictures in from Sazi, who I believe is in the room here. Certainly looks like a packed house that's there waiting for the comments from President Trump. But what's the mood like there on the ground?
Yeah, Shauna, I was just in the Congress Hall about 25 minutes ago, and people were lining up to sit down in the hall to hear what the president has to say. I saw Brian Moynihan, who's going to be one of the executives, taking questions from the president and chatting with the president after his remarks, also making his way through the crowd. I think there's an acceptance here that Donald Trump is president, and the major line of dialogue is, what are the tariffs going to look like, and how are they going to affect me? In addition to that, I think AI has been the real buzz here, but really the elephant in the room in every single conversation, whether it's been climate to AI to tariffs, has been Donald Trump. And the onlookers at this conference are very keen on what the president is going to say.
Yeah, Jennifer, there's certainly been a lot of conversation about those tariffs coming from Davos. We heard Jamie Dimon basically saying it's no big deal. It's a national security risk. Get over it. What else have you heard from sources on the ground just about the optimism surrounding Trump's tariff policies, especially after it wasn't specifically mentioned in that inaugural address?
I think there's been a very conciliatory tone here. Folks really want to work with the president on this. The EU has said that. China has said that. China has said tariffs are not the way, but we do want to invest in the U.S. and we do want to work with the new administration. The general director of the World Trade Organization told policymakers this morning from countries ranging from Brazil to China, guys, maybe we should, quote, chill for a second here. Let's actually see if this is a negotiating tool and what we actually see take place. Sarah Huckabee Sanders, governor of Arkansas, was just on stage a bit ago saying Trump is the ultimate negotiator, and she also believes this is going to be a tool for negotiations. And let's see where this leaves the U.S.
All right, Jennifer, thank you so much. Appreciate that. And that is, of course, something that makes sense given Sanders being part of the former Trump administration under Trump 1.0. But coming up, we will bring you full coverage of Trump's special address in Davos, followed by expert analysis from that event. So stay tuned right here on Yahoo Finance for more.
Welcome to Yahoo Finance. I'm Brad Smith. Alongside Madison Mills, we are awaiting remarks from President Donald Trump, who will virtually address business and political leaders at the World Economic Forum in Davos, Switzerland.
And after that speech, the president will answer questions from a number of business leaders, including Blackstone CEO Steve Schwarzman, Bank of America CEO Brian Moynihan, and the CEO of Santander, and the chairman and CEO of Total Energies. Some of the top things we are watching, of course, energy and tariffs are going to be key to this conversation here. Looking for clarity still from the markets on what those tariff policies are actually going to look like moving forward here, Brad. I think that's something that we can expect to hear some questions on. Obviously interested in hearing what these CEOs have to ask. Doubtful that they'll necessarily be pressing the president as much as perhaps a journalist might, given that relationship building component here, but definitely interested to hear what those questions involve.
Yeah, and by all means, we're going to be watching to see what the president says about the U.S. economy with relation to some of the other political leaders that will be in attendance listening in, as well as some of the business leaders. And we had the opportunity to speak with Mohamed El-Erian, especially within the chorus of economists that we have gotten response and some of the different takes about the economy, from which, let's remember, by all stretch of the imagination, he's inheriting a pretty good economy, regardless of whether or not he would like to declare a national economic emergency. There have been so much of the points back to, like Mohamed El-Erian has made to us, that the global economy and where the U.S. sits within that, the U.S. is doing fine. It's more a matter of where policy comes forward and where that can rattle some of the nerves right now. And certainly that's been the breadth of the conversation that's been taking place, at least from what we've been hearing from our own Brian Sazi and from our own Jennifer Schonberger in Davos, Switzerland as well. And the comments that I was mentioning from Mohamed El-Erian to us, saying that you cannot run an economy with K-shaped characteristics for a long time. Just like at some point we have to worry about the bad and the ugly of the global economy. For the good of the global economy, the U.S., the bad, China, and the ugly, Europe, is what Mohamed El-Erian's words were to us. And so these are all the three major economic areas, and there's massive divergence as well there that he's continuing to track.
Yeah, and you can see a live shot up right now of the room where we are awaiting those remarks. Again, Trump is not going to be on the ground from Davos, but he will be joining there virtually with this speech. You can see individuals flooding into the room in order to hear those remarks. I did just want to level set, if we can prepare the soundbite from President Trump from earlier this week, to remind our audience exactly where we are at right now with regards to tariffs. Here's what President Trump had to say about those tariffs from the Oval Office this week.
We're talking about a tariff of 10% on China based on the fact that they're sending fentanyl to Mexico and Canada. Probably February 1st is the date we're looking at.
We have full coverage of the event. Our own senior reporter Jennifer Schonberger is live on the ground in Davos. We've also got a great panel of guests ready to react for us. Nancy Tangler, CEO and CIO of Laffer Tangler Investments. We've got Jose Torres, senior economist over at Interactive Brokers, and Matthew Axe. He is the senior strategist at Evercore ISI, certainly going to be responding to the likes of any tariff news that we do get. Again, we were just listening to that soundbite there from the president talking about those tariffs earlier this week. Interesting to see the president's focus on Mexico and China teasing out, Mexico and Canada rather, teasing out those 25% tariffs. On the campaign trail, he did talk about as high as 60% tariffs on any products incoming from China. Now from the Oval Office, as you just heard, he's talking about a decrease from that campaign rhetoric to 10% tariffs on China. So investors and strategists we've been speaking with throughout the week, really trying to suss out what the net rate on tariffs is going to look like and how that might impact things like GDP, like inflation. We heard Torsten Slok earlier this week saying inflation could be fueled by as much as 0.5% just due to those tariffs on China alone. So the market really trying to price in how much risk there is going to be from tariffs. We have seen the market kind of sloughing that off this week. Brad, I know that you're taking a look at the major averages as we do await these remarks from President Trump here.
Yeah, what's old is new again. And when we do get some of those mid-market or intraday session comments from President Trump, they have the tendency, of course, to move markets. We're going to be continuing to track, of course, some of the activity that we've seen over the course of today, where largely for the intraday activity, we've been watching a Dow Jones Industrial Average that's continued to be in positive territory. It's up right now by about 0.4%. The Nasdaq Composite, that's been worth keeping tabs on here. If we put a little bit more of a stretch on the timeline here, you can see exactly where we've moved higher by about 2.3% over the past 5 days here, but down fractionally here on the day. And the S&P 500 500, which did see an intraday record yesterday, and right now, seeing some gains to the upside by about 0.1% over that past 5-day period. We're continuing to hold steady right now, 2.4% in gains that we're seeing over that period in time. And then just most notably, of course, with some of the announcements that we have seen come forward from the Trump administration, of course, early days here, there's been a lot of focus on technology and where within Stargate there would be some winners and losers, those companies who were going to benefit as a result of some of the early announced partnerships or investments, dollars that are earmarked to the tunes of hundreds of billions of dollars coming forward from nation states, but also some of the larger companies here that we're continuing to keep close tabs on. And as we're taking a look at some of the larger players here within the Nasdaq 100, there are a little bit of a divergence between some of the companies that, of course, were mentioned early days and some of those that are still going to be working with the new administration, the return Trump 2.0 administration, we should say, with some of those AI ambitions. And we'll see to what extent AI is discussed as well here coming into this particular address here and the commentary that we get from President Trump as well.
Yeah, and right now, as we are awaiting those remarks from Trump, Klaus Schwab, he is the executive chairman of the World Economic Forum, is appearing on screen, starting to prepare to introduce the president. You can see Klaus on your screen here. And it's interesting, we're getting some reports from the ground about who is in this room here. Some of the biggest names in the world. Christine Lagarde is reportedly in the room. Al Gore, billionaire, is also reportedly in the room. Still a couple of empty seats waiting for latecomers, certainly those individuals who are preparing to ask questions. You can see on that stage, again, Bank of America CEO Brian Moynihan among those. We're going to take a listen in as we prepare to hear from President Trump from Davos.
Well, thank you very much, Klaus, and hello to everyone in beautiful Davos. This has been a truly historic week in the United States. 3 days ago, I took the oath of office, and we began the golden age of America. The recent presidential election was won by millions of votes, and all seven, every one of them, all seven swing states. It was a massive mandate from the American people like hasn't been seen in many years. And some of the political pundits, even some of my so-called enemies, said it was the most consequential election victory in 129 years. That's quite nice. What the world has witnessed in the past 72 hours is nothing less than a revolution of common sense. Our country will soon be stronger, wealthier, and more united than ever before, and the entire planet will be more peaceful and prosperous as a result of this incredible momentum and what we're doing and going to do. My administration is acting with unprecedented speed to fix the disasters we've inherited from a totally inept group of people and to solve every single crisis facing our country. This begins with confronting the economic chaos caused by the failed policies of the last administration. Over the past 4 years, our government racked up $8 trillion in wasteful deficit spending and inflicted nation-wrecking energy restrictions, crippling regulations, and hidden taxes like never before. The result is the worst inflation crisis in modern history and sky-high interest rates for our citizens and even throughout the world. Food prices and the price of almost every other thing known to mankind went through the roof. President Biden totally lost control of what was going on in our country, but in particular with our high inflation economy and at our border. Because of these ruinous policies, total government spending this year is $1.5 trillion higher than was projected to occur when I left office just 4 years ago. Likewise, the cost of servicing the debt is more than 230% higher than was projected in 2020. The inflation rate we are inheriting remains 50% higher than the historic target. It was the highest inflation probably in the history of our country. That's why from the moment I took office, I've taken rapid action to reverse each and every one of these radical left policies that created this calamity, in particular with immigration, crime, and inflation. On day one, I signed an executive order directing every member of my cabinet to marshal all powers at their disposal to defeat inflation and reduce the cost of daily life. I imposed a federal hiring freeze, a federal regulation freeze, a foreign aid freeze, and I created the new Department of Government Efficiency. I terminated the ridiculous and incredibly wasteful Green New Deal. I call it the Green New Scam. Withdrew from the one-sided Paris Climate Accord and ended the insane and costly electric vehicle mandate. We're going to let people buy the car they want to buy. I declared a national energy emergency, and it's so important, national energy emergency to unlock the liquid gold under our feet and pave the way for rapid approvals of new energy infrastructure. The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto. My administration has also begun the largest deregulation campaign in history, far exceeding even the record-setting efforts of my last term. In total, the Biden administration imposed $50,000 in additional regulatory costs on the average American household over the last 4 years. I have promised to eliminate 10 old regulations for every new regulation, which will soon put many thousands of dollars back in the pockets of American families. To further unleash our economy, our majorities in the House and Senate, which we also took along with the presidency, are going to pass the largest tax cut in American history, including massive tax cuts for workers and family, and big tax cuts for domestic producers and manufacturers. And we're working with the Democrats on getting an extension of the original Trump tax cuts, as you probably know, by just reading any paper. My message to every business in the world is very simple. Come make your product in America, and we will give you among the lowest taxes of any nation on earth. We're bringing them down very substantially, even from the original Trump tax cuts. But if you don't make your product in America, which is your prerogative, then very simply you will have to pay a tariff, differing amounts, but a tariff which will direct hundreds of billions of dollars and even trillions of dollars into our Treasury to strengthen our economy and pay down debt. Under the Trump administration, there will be no better place on earth to create jobs, build factories, or grow a company than right here in the good old USA. Already Americans' economic, you can see this, I think, maybe even in your wonderful, wonderful room that you're all gathered together, so many of my friends, but Americans, the economic confidence is soaring like we haven't seen in many, many decades, maybe not at all. Upon my election, it was just announced that small business optimism skyrocketed by 41 points in a single month. That's the highest ever. There's never been anything like that. SoftBank has announced between a $100 and $200 billion investment in the U.S. economy because of the election result. And just 2 days ago, Oracle, SoftBank, and OpenAI announced a $500 billion investment in AI infrastructure. Other companies likewise have announced billions and billions and billions, adding up to trillions of investment in America, in the United States. And it's also reported today in the papers that Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down, which, frankly, I'm surprised they didn't do before the election. That didn't show a lot of love by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately. Right now, the price is high enough that that war will continue. You got to bring down the oil price. You got to end that war. They should have done it long ago. They're very responsible, actually, to a certain extent, for what's taking place. Millions of lives are being lost. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us. All over the progress that you're seeing is happening because of our historic victory in a recent presidential election. one that has become quite well known throughout the world. I think a lot of things are happening to a lot of countries. They say that there's light shining all over the world since the election, and even countries that we aren't particularly friendly with are happy because they understand what there is a future and how great the future will be. Under our leadership, America is back and open for business. And this week, I'm also taking swift action to stop the invasion at our southern border. They allowed people to come in at levels that nobody's ever seen before. It was ridiculous. I decided and declared to do, and very, very importantly, a national emergency on our border, immediately halted all entry of illegal border crossers, of which there were many, and began promptly returning the illegal trespassers back to the place from which they came. That action, as you've probably seen, has already started very strongly. I've deployed active duty U.S. military and National Guard troops to the border to assist in repelling the invasion. It was really an invasion. We will not allow our territory to be violated. After 4 long years, the United States is strong and sovereign and a beautiful nation once again. It's a strong, sovereign nation. In addition, I'm pleased to report that America is also a free nation once again. On day one, I signed an executive order to stop all government censorship. No longer will our government label the speech of our own citizens as misinformation or disinformation, which are the favorite words of censors and those who wish to stop the free exchange of ideas and, frankly, progress. We have saved free speech in America, and we've saved it strongly. With another historic executive order this week, I also ended the weaponization of law enforcement against the American people and, frankly, against politicians, and restored the fair, equal, and impartial rule of law. My administration has taken action to abolish all discriminatory diversity, equity, and inclusion nonsense. And these are policies that were absolute nonsense throughout the government and the private sector. With the recent yet somewhat unexpected great Supreme Court decision just made, America will once again become a merit-based country. You have to hear that word, merit-based country. And I've made it official, an official policy of the United States, that there are only 2 genders, male and female. And we will have no men participating in women's sports, and transgender operations, which became the rage, will occur very rarely. Finally, as we restore common sense in America, we're moving quickly to bring back strength and peace and stability abroad. I'm also going to ask all NATO nations to increase defense spending to 5% of GDP, which is what it should have been years ago. It was only at 2%, and most nations didn't pay until I came along. I insisted that they pay, and they did, because the United States was really paying the difference at that time, and it was unfair to the United States. But many, many things have been unfair for many years to the United States. Before even taking office, my team negotiated a ceasefire agreement in the Middle East, which wouldn't have happened without us, as I think most of the people in the room know. Earlier this week, the hostages began to return to their families. They are returning, and it's a beautiful sight, and they'll be coming in more and more. They started coming back on Sunday. Our efforts to secure a peace settlement between Russia and Ukraine are now hopefully underway. It's so important to get that done. That is an absolute killing field. Millions of soldiers are being killed. Nobody's seen anything like it since World War II. They're laying dead all over the flat fields. It's a flat field farmland, and there's millions of Russians and millions of Ukrainians. Nobody's seen anything like it since World War II. It's time to end it. And here in America, we have big events coming up. Next year, we have the 250th anniversary of America's founding. I'm so honored to be president during that. That's been a big event. They've been talking about it for 10 years. We also have the World Cup, and I understand Gianni's in the room. Infantino, he was very instrumental in helping us get it. He's there with you someplace, I think, and I want to thank him for that. And then we have the Olympics coming up, which I was instrumental in getting also in my first term. And who would have known that by skipping a term, I would get the Olympics? I was upset. I said, you know, I got the Olympics to come and I won't be president. But it turned out through a stroke of luck, or whatever you might call it, that I'm going to be president during the World Cup and the Olympics and the 250th anniversary. So that's going to be 3 big events. And we've accomplished more in less than 4 days. We have really been working 4 days than other administrations have accomplished in 4 years. And we're just getting started. It's really an amazing thing to see. And the spirit and the light over our country has been incredible. Under the last administration, our nation has suffered greatly. But we're going to bring it back and make it greater, bigger, stronger, better than ever before. I want to thank everybody for being with you. I would have been there myself, except the inauguration was 2 days ago. I thought it might be a little bit quick to make it the first stop. But we'll get there one day. We hope to get there. But I do appreciate, I heard the audience is fantastic, and many of my friends are in the audience. And I will be taking questions now from some very distinguished people. Thank you all very much.
Thank you. Thank you very much, Mr. President, for that very powerful speech. And I think you could hear the applause all the way from Davos to the White House. But next year it will be even better, because then you can get the applause here in Davos. So we wish you welcome to our village next year. We hope to see you.
Thank you very much.
So we also know, Mr. President, that you open up for interaction here. We have a great panel with some of the most distinguished business people in the world. Let me start with someone that you know really well, that I think is almost a neighbor of you in Florida. Mr. Steve Schwarzman, Chairman, CEO, and co-founder of Blackstone Group. So, Steve, floor is yours.
Well, Mr. President, I'm sure the Crown Prince of Saudi Arabia will be really glad you gave this speech today. You've had the busiest 4 days that anybody can imagine, and congratulations for that. My question is about some of the things I've observed here at Davos. It's a terrific forum. I've met lots of people, as usual. I think I've been here 30 years. And a lot of the European business people have expressed enormous frustration with the regulatory regime in the EU. And they attribute slower growth rates here because of the numerous factors, but especially because of regulations. And you've taken a completely different approach in this area. And if you could explain the theory of what you're doing, how you're going to do it, and what you expect the outcome to be, I'd appreciate it.
Well, thank you very much. And congratulations, Steve. You're a friend of mine, but on a great career. You have had an amazing career, and it continues. So I just want to congratulate you. Very inspirational to a lot of people. I want to talk about the EU, because you mentioned specifically that I have also had a lot of friends and leaders of countries. I've gotten to know them all my first term and a little bit during this period of 4 years, and know them well, like them a lot, but they're very frustrated because of the time everything seems to take to get approved, environmental impact statements for things that you shouldn't even have to do that, and many, many other ways that it takes. And I'm going to give you a quick little example. In the private life, my beautiful private life, before I had all these things happening, the world is a little different. I had a nice, simple life. You knew that. But when I had that simple life, I did projects. And I had a big project in Ireland. And it had to get approval on something that would have made it even better. And I got the approval from Ireland in a period of a week. And it was a very, very, very efficient, good approval. And they informed me, though, the problem is you're going to have to get it from the EU, and we think that'll take 5 to 6 years. And I said, you have to be kidding. And this was before politics. And I said, wait a minute, it's not that important. I don't want to go 5 or 6 years, but it would have been a big investment. It would have been nice, and it would have been good for the project. And I sent the people to the EU to see if they could speed it up. And basically, it was a 5 or 6 year wait just to get a simple approval that Ireland gave me in a period of literally not much more than a week. And I realized right then, that was the first time I really was involved with the EU, but I realized right then that's a problem. And I didn't even bother applying to do it. Or if I did, I pulled it very quickly. I have to be very accurate because I don't want to be criticized. He did apply, actually. No, I want to be very accurate. So I don't think I did, but if I did, I pulled it very quickly. It was just something you couldn't wait 5 years or 6 years to get an approval. So a lot of, in a very big business sense, a lot of people are claiming that's the problem. From the standpoint of America, the EU treats us very, very unfairly, very badly. They have a large tax that we know about, and a VAT tax, and it's a very substantial one. They don't take essentially don't take our farm products, and they don't take our cars, yet they send cars to us by the millions. They put tariffs on things that we want to do, like, for instance, I think they actually, in terms of these are non-economic or non-monetary tariffs, and those are very bad, and they make it very difficult to bring products into Europe, and yet they expect to be selling, and they do sell their products in the United States. So we have, hundreds of billions of dollars of deficits with the EU, and nobody's happy with it, and we're going to do something about it, but nobody's happy with it. So I think the EU has to speed up their process. Friends of mine that are in some of the nations within the EU, great people, they want to be able to compete better, and you can't compete when you can't go through the approval process fast. There's no reason why it can't go faster. So, I'm trying to be constructive because I love Europe. I love the countries of Europe, but the process is a very cumbersome one, and they do treat the United States of America very, very unfairly with the VAT taxes and all of the other taxes they impose. One other, just to finish up, I got a call from the head of a major airline, one of the biggest airlines in the world, and he said, sir, could you help us? What? Landing in Europe is brutal. They charge us fees for everything, and it's so unfair. I said, how does it compare to China? He said, it's much worse. And the other thing, as you know, they took court cases with Apple, and they supposedly won a case that most people didn't think was much of a case. They won 15 or 16 billion from Apple. They won billions from Google. I think they're after Facebook for billions and billions. These are American companies, whether you like them or not. They're American companies, and they shouldn't be doing that. And that's, as far as I'm concerned, it's a form of taxation. So we have some very big complaints with the EU. Thank you.
Thank you very much, Mr. President. We'll now go to one of your friends in the EU, Patrick Pouyanné. He's the chairman CEO of Total Energies. I guess you have a question ready, Patrick, for the president.
Mr. President, as we understand, energy is at the top of your agenda, and it's an honor for me to represent the energy industry tonight. In this panel, Total Energies is indeed the fourth largest oil and gas and electricity company in the world. I will not ask you a question about the oil price. It's quite clear what you expect from us. I will go to gas more. And our company is the largest #1 exporter LNG from the US company. We are a strong contributor to, and we invest in a mammoth LNG projects in Texas, $20 billion. It's far from 200, but it's $20 billion. And we contribute with that to security of supply to Europe as we export this LNG to Europe. Some experts fear that if there are too many projects developed in the US on LNG, this could have an inflationary impact on the US domestic gas price. And they recommend a pause on these projects. I would ask you the following question: what are your views about such a pause on investments on LNG in the US? What would happen if you would observe an increased domestic gas price because of these exports? And final question, which is important for Europe: would you agree to guarantee security of supplies of US LNG to Europe?
Well, on the last part of your question, yes, I would. I would make sure that you get it. If we make a deal, we make a deal, you'll get it. Because a lot of people do have that problem. They make a deal and then it can't get supplied because of war-type problems and other problems. So we would absolutely do that. LNG is very interesting because when I took office for the first term, one of the first things I looked at was there were two very massive plants in Louisiana, a state that has been very good to me, won it by many, many points. And I felt strongly indebted to it, actually. And they said there are two plants that have been under environmental consideration for more than 10 years. And they were costing, as you say, you know how expensive those plants are, but they were costing like 12 billion and I think 14 or 15 billion, but they couldn't get their permits. They were in review for years, many, many years, like a decade or more. And I said, so ridiculous. I know so much about that because in the construction industry, I had to go through it too, but I got good at it after a while. But I saw the projects, and you're talking about a total investment of 25 to $30 billion, and it looked like it was going to end. They couldn't get their permits, and I got them done in less than a week. It was done, completed. In fact, when they called them to announce that it was done, the countries, largely countries, Japan was involved and another country and some very big investors, they couldn't believe it. They actually couldn't believe it. And I said, just do yourself one favor. Don't pay any consultants, because the only one that got it done was me. I got it done because it was the right thing to do for the U.S. and for the world, but the consultants had nothing to do with it. You know, the consultants go in and they say, give us millions of dollars because Trump did it. Nobody called me about it. I just heard it was a problem for years. And I got it done because it was the right thing to do for the U.S. and the right thing to do for beyond. It had to do with energy, very important. So I think it's very important. I think I disagree with one. I think the more that you do, the lower the price is going to go. And what I'd like to see is rapid approvals. We're going to give very rapid approvals in the United States, like with the AI plants, talking to many people want to build them. That's going to be a very big thing. We're going to build electric generating facilities. They are going to build. I'm going to get them the approval. Under emergency declaration, I can get the approvals done myself without having to go through years of waiting. And the big problem is we need double the energy we currently have in the United States. Can you imagine? For AI to really be as big as we want to have it, because it's a very competitive, it'll be very competitive with China and others. So I'm going to give emergency declarations so that they can start building them almost immediately. And I think it was largely my idea because nobody thought this was possible. It wasn't that they were not smart, because they're the smartest. But I told them that what I want you to do is build your electric generating plant right next to your plant as a separate building, connected. And they said, wow, you're kidding. And I said, no, I'm not kidding. You don't have to hook into the grid, which is old and, could be taken out. If it's taken out, they wouldn't have any way to get any electricity. So we are going to allow them to go on a very rapid basis to build their plant, build the electric generating plant. They can fuel it with anything they want, and they may have coal as a backup, good, clean coal, If there were a problem with a pipe coming in, as an example, you're going with gas, oil or gas, and a pipe gets blown up or for some reason doesn't work, there are some companies in the U.S. that have coal sitting right by the plant so that if there's an emergency, they can go to that short-term basis and use our very clean coal. So that's something else that a lot of people didn't even know about, but nothing can destroy coal, not the weather, not a bomb, nothing. It might make it a little smaller, might make it a little different shape, but coal is very strong as a backup. It's a great backup to have that facility, and it wouldn't cost much more money. And we have more coal than anybody. We also have more oil and gas than anybody. So we're going to make it so that the plants will have their own electric generating facilities attached right to their plant. They don't have to worry about a utility. They don't have to worry about anything. And we're going to get very rapid approvals.
Thank you. Thank you so much, Mr. President. We'll now go to another CEO that you know very well, Brian Moynihan, the CEO and Chair of Bank of America.
Good afternoon, Mr. President, and congratulations and obviously eventful week for you and your family. If you remember 5 years ago, you came here and we walked among 150 CEOs from all over the world and you engaged with them about your policies and your procedures. This year you're not here, and yet this week was eventful from the orders that you mentioned earlier, literally a wave of orders coming out on immigration, on trade, and many other matters. And so as a representative of the United States here, we got a lot of questions about what does all this mean and how would the president square this with his clear focus on growth, prosperity, market growth, stock market growth, a good bond market, and bringing down prices. So how do you think about the impact of all these orders and how fast they come out and how you're going to balance them with that scorecard of being successful in both continuing GDP growth, bringing down inflation, and also having a good stock price appreciation for the American citizen?
Well, I think it's going to actually bring down inflation. It's going to bring up jobs. We're going to have a lot of jobs. We're going to have a lot of companies moving in. You know, Brian, we're at 21%. It was at 40%, and I got it down to 21%, the corporate tax. And it was actually, if you look at state and city, it was in many cases much higher than 40%. I got it down to 21%. And now we're going to bring it down from 21 to 15% if, there's a big if you make your product in the U.S. So we're going to have the lowest, just about the lowest rate. It'll be, the 21 is on the low side worldwide. The 15 is about as low as it gets. And by far the lowest of a large country, a large, you know, rich, powerful country by far, not even a contest. So we're going to bring it down to 15% if you make your product in the USA. So that's going to create a tremendous buzz. We're also probably going back to the one-year deduction where we deduct, you know, we did that originally, and that was amazing what the impact that had, the one-year deduction, which built up over a period of time, and then it expires. But we're going to go back to that when we do the renewal of the Trump tax plan. We have to get Democrats to approve it. But, you know, if the Democrats didn't approve it, I don't know how they can survive with about a 45% tax increase, because that's what it would be. And so I think they're going to be. We've been working along with them pretty well. I think it's very hard for a political group to say, let's charge people 45% more. So I think we're in good shape, but we're actually doing a reduction for business and small businesses where you're going to bring it down to 15%, which is really something. And by the way, speaking of you, and you've done a fantastic job, but I hope you start opening your bank to conservatives, because many conservatives complain that the banks are not allowing them to do business within the bank, and that included a place called Bank of America. They don't take conservative business. And I don't know if the regulators mandated that because of Biden or what, but you and Jamie and everybody, I hope you're going to open your banks to conservatives, because what you're doing is wrong.
Mr. President, I'll say that your friend Gianni said hello, told me to tell you hello, and we look forward to sponsoring the World Cup when it comes, both this summer for the club and next year. So thank you for getting that for the United States.
Thank you very much, Brian.
Thank you, Mr. President. We'll now go to Anna Butin. She's the executive chairman of Banco Santander, one of the big European banks, and also in the U.S. So, Anna.
Mr. President, congratulations on a historic victory. I believe you don't know me as well as my fellow panelists, so a few words. Santander is one of the largest banks in the world by number of customers, 170 million. That's more than my friend Brian or my friend Jamie have. And those...
They fixed the regulation.
That's coming, that's coming.
That was cheeky.
we're a big investor in the United States. We have many million customers, 12,000 employees. We're one of the largest auto lenders. And we recently launched a fully digital bank called Open Bank. We strongly believe banks have a pivotal role in the economy, and we can accelerate growth and help many more customers. That's what we're doing in the United States. So, as Brian pointed out, we very much welcome your focus on deregulation and reducing bureaucracy. So my question is, what are your priorities in this regard, and how fast is this going to happen? Thank you very much.
I think it's going to, thank you and congratulations. I know very much about your bank, and you've done a fantastic job. Congratulations. We are going to move very quickly. We've moved very quickly. We've done things in the last 3 days that nobody thought were possible to do in years. And it's all taking effect. It's going to have a huge impact on the economy, a huge positive impact. Money was being wasted on crazy things. I mean, the Green New Deal was such a total disgrace, how that was perpetrated. And it was conceived of by people that were average students, less than average students, I might add, and never even took a course in energy or the environment. It was just a game. Remember, the world was going to end in 12 years? Remember that? Well, the 12 years has come and gone. It was going to end. It was going to all foam into earth. But, you know, the time has come. These people, and they really scared the Democrats large. I can't say the Republicans. The Republicans maybe could have fought harder to stop it, but it's been a tremendous waste of money. You know, during my 4 years, we had the cleanest air, we had the cleanest water, and yet we had the most productive economy in the history of our country. We had the most productive economy. Until COVID came, we had the most productive in the history of our country by far. And actually, you can look worldwide. We were beating everybody from China to everybody else. So, and we think we really now, with what we have learned and all of the other things that have taken place, we think we can even far surpass that, actually far, far surpass it. But we do, one thing we're going to be demanding is we're going to be demanding respect from other nations. Canada, we have a tremendous deficit with Canada. We're not going to have that anymore. We can't do it. I don't know if it's good for them. As you probably know, I say you can always become a state. And if you're a state, we won't have a deficit. We won't have to tariff you, et cetera, et cetera. But Canada has been very tough to deal with over the years. And it's not fair that we should have a $200 billion or $250 billion deficit. We don't need them to make our cars, and they make a lot of them. We don't need their lumber because we have our own forests, et cetera, et cetera. We don't need their oil and gas. We have more than anybody. So, you know, just as an example, with Mexico, we're dealing with Mexico, I think, very well. And we're just, you know, we just want to be treated fairly with other nations, because there's hardly a nation in the world, and I blame this on us, and I blame it on politicians that, for some reason, mostly it's stupidity, but you could also say other reasons, but mostly stupidity. They've allowed other nations to take advantage of the U.S., and we can't allow that to happen anymore. You know, we have debt. It's a very small debt when you compare it to the value of the assets that we have, but we don't want to do that. We want to just have debt be obliterated, and we'll be able to do that fairly rapidly. And a lot of good things are going to happen. And honestly, good things are going to happen for the world, and good things are going to happen for the people that are dealing with us, allies and beyond allies. One thing very important, I really would like to be able to meet with President Putin soon and get that war ended. And that's not from the standpoint of economy or anything else. It's from the standpoint of millions of lives are being wasted. Beautiful young people are being shot in the battlefield. You know, the bullet, very flat land, as I said, and the bullet goes, there's no hiding. And a bullet, the only thing going to stop the bullet is a human body. And you have to see, I've seen pictures of what's taken place. It's a carnage, and we really have to stop that war. That war is horrible. And I'm not talking economy. I'm not talking economics. I'm not talking about natural resource. I'm just talking about There's so many young people being killed in this war, and that's not including the people that have been killed as the cities are being, knocked down building by building. So we really should get that stopped. Likewise, in the Middle East, I think we've made a lot of progress in the Middle East, and I think that's gonna come along pretty well. Thank you.
Thank you, Mr. President. We know that the most consequential relationship in the world is between the U.S. and China. U.S. 28% of the global economy, China close to 20%. That's almost half of the global GDP. And we know that you called President Xi Jinping last Friday. We heard that you had a good discussion. How do you see the relationship between the U.S. and China in the next 4 years under your leadership?
He called me, but I see it very good. I think that we're going to have a very good relationship. All we want is fairness. We just want a level playing field. We don't want to take advantage. We've been having massive deficits with China. Biden allowed it to get out of hand. He's $1.1 trillion deficit. It's ridiculous. And it's just an unfair relationship. And we have to make it just fair. We don't have to make it phenomenal. We have to make it a fair relationship. Right now, it's not a fair relationship. The deficit is massive, as it is with other countries, a lot of Asian countries, actually. But we have deficits that are very big, and we can't keep doing that. So we're not going to keep doing that. But I like President Xi very much. I've always liked him. We always had a very good relationship. It was very strained with COVID coming out of Wuhan. Obviously, that strained it. I'm sure it strained it with a lot of people, but that strained our relationship. But we always had a great relationship, I would say, and we look forward to doing very well with China and getting along with China. Hopefully, China can help us stop the war with, in particular, Russia, Ukraine. And they have a great deal of power over that situation. And we'll work with them. And I mentioned that during our phone conversation with President Xi. And hopefully we could work together and get that stopped. We'd like to see denuclearization. In fact, with President Putin prior to an election result, which was frankly ridiculous, we were talking about denuclearization of our two countries, and China would have come along. China has a much smaller, right now, nuclear armament than us, or field than us, but they're going to be catching it at some point over the next 4 or 5 years. And I will tell you that President Putin really liked the idea of cutting way back on nuclear. And I think the rest of the world, we would have gotten them to follow. And China would have come along, too. China also liked it. Tremendous amounts of money are being spent on nuclear. And the destructive capability is something that we don't even want to talk about today because you don't want to hear it. It's too depressing. So we want to see if we can denuclearize, and I think that's very possible. And I can tell you that President Putin wanted to do it. He and I wanted to do it. We had a good conversation with China. They would have been involved, and that would have been an unbelievable thing for the planet.
Mr. President, when you're back here in Davos next year, will there be then a peace agreement with Ukraine and Russia by then?
Well, you're going to have to ask Russia. Ukraine is ready to make a deal. Just so you understand, this is a war that should have never started. If I were president, it would never have started. This is a war that should have never, ever been started. And it wasn't started during there was never even talk about it. I knew that it was the apple of President Putin's eye, but I also knew that there was no way he was going in, and he wasn't going to go in. And then when I was out, bad things happened, bad things were said, a lot of stupidity all around, and you end up with what you have. Now you have all these bombed out cities. They look like demolition sites with many people killed. I think the thing that you'll see about Ukraine is that far more people have died than is being reported. And I've seen that. But far, far more people have died. When you look at a city that's become a demolition site where big buildings have been collapsed by missiles hitting them and everything else, and they say one person was slightly injured. No, many people were killed. Those are big buildings. I was surprised at how that was my business. These are buildings that go 2 and 3 blocks long. They're 20 stories high. They're big, powerful buildings, and they were knocked down, and there were a lot of people in those buildings. That announced that 2 people were injured. That's not true. So I think you're going to find that there were many more people killed in Ukraine in the Ukraine war than anybody has any idea. But if you look now, so many of the people being killed are soldiers just facing each other with guns, rifles, and drones, the new form of warfare, drones. And it's a very sad thing to see. And when you see pictures of the fields that I see, nobody wants to see it. You'll never be the same.
Thank you very much, Mr. President, on behalf of all the 3,000 participants here in Davos. We really underline that joining us the third day in your presidency, live taking questions here is so appreciated, and we are already ready for receiving you next year in person. So thank you very much, and all the best from Davos.
Thank you. Thank you very much.
That was President Donald Trump virtually addressing political and business leaders at the World Economic Forum in Davos, Switzerland. A lot of big headlines here, but Trump's main message when it comes to tariffs, he said, come to America and get low taxes. If you stay out, that is your prerogative, but you will be paying tariffs. And he talked about the importance of that as part of his efforts to tackle the deficit here. So not necessarily getting clarity on those tariffs, but hearing him talk about it again. He also talked with Brian Moynihan, CEO of Bank of America, about lowering the corporate tax. He wants to lower it to 15% again if the product is made in the U.S. We saw a lot of market moves throughout the session here during these remarks, the market kind of moving back to the upside. And we saw oil in particular, natural gas, taking a dive after Trump talked about increased oil production. Here's what he had to say about how that could impact the Federal Reserve's path forward.
And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us.
So, Brad, he talked about the importance of lowered interest rates across the globe. You can see those oil moves here hitting session lows for the day.
Yeah. One of the other things that we've been continuing to track is what he was saying about energy and what type of energy would be necessary as well in order for artificial intelligence to really move forward at this juncture. And he was talking specifically about energy and trying to make sure that within that we have the number and the amount of energy that is necessary in order for some of the artificial intelligence and data center power that is also being discussed here as well. And so even as we're thinking about what that would be necessary in the type of investment for artificial intelligence, it also comes in tandem with energy. He said that we needed to double, essentially, the amount of energy that we do have in order for some of the data centers and artificial intelligence investments that have started to be touted this week as via Stargate to really come to fruition at this juncture. We've also got Jennifer Schomburger live on the ground in Davos. Jen, want to get some of your takeaways as well.
Yeah, I agree with you guys. President Trump sending a message loud and clear to companies around the globe. Come to America, make your product in the U.S., and we will give you a low tax rate. Otherwise, we will slap a tariff on you. The trade narrative was loud and clear. The president racking on the European Union, saying he's just trying to be constructive. He wants a level playing field, talking about the VAT tax here in Europe. He also talked about Canada, saying we don't need their oil, we don't need their lumber, we need to make cars in the United States. And he also talked about China and said that he thinks that he will have a good relationship with President Xi, who called President Trump earlier in the week. But he says that right now, the playing field is just not level. It's unfair. And it doesn't have to be a great relationship. It just needs to be a fair one at that. You guys mentioned energy. That was also a major theme in his remarks. He says he's talked to Saudi Arabia about a $600 billion investment in the United States, but he wants them to round that up to $1 trillion. He's also going to ask Saudi Arabia to pressure OPEC to lower oil prices, hearing that oil is dropping on the back of that as well. He also says he wants to speak with President Putin as soon as possible to try to end this war in Ukraine. Great emphasis, again, on tariffs, on taxes. He also said he wants to work with Democrats to get the tax cuts that he passed during his first term extended and made permanent. He says, I can't imagine the Democrats would support a 45% tax increase at this point. Guys.
All right, Jennifer, thanks so much for staying tuned and listening in and giving us some of the reactions there. Boots on the ground. Appreciate it. Let's get to our panel here that we've got standing by. Nancy Tengler, who's the CEO and CIO of Laffer Tengler Investment. We've also got Jose Torres, who is the senior economist at Interactive Brokers, and Matthew Axe, who is the senior strategist at Evercore ISI. Great to have you all here with us. Nancy, I just want to begin with you. As you heard some of the comments and the question and answer that was going forward between President Trump and some of the selected officials and business leaders that were on stage, what most notably does this early administration now signal about the coming years and even days as it gets closer to announcing some of the more specific tariff, perhaps ins and outs that they're thinking through?
Yeah, well, thank you so much for having me. And I think one of the things we've learned over the years with President Trump is you need to pay attention to sort of the trends and the strategy and maybe not so much to the numbers. For example, the most recent inflation was not the worst inflation we've had in the history of the country. That happened under the Carter administration, and it was double what we saw a few years back. But in general, I think the message is very optimistic. And the three takeaways for me were energy prices are coming down, and I had submitted that to you in my notes. I think that will put downward pressure on inflation that tariffs might mitigate. But remember, too, we had tariffs in the first Trump administration, and inflation stayed below 2% the entire time. So I don't think tariffs are by definition inflationary. It depends on how you use them. So energy prices are coming down. I think tax rates are clearly coming down. If he doesn't get to 15% on corporate tax rates and only 18%, that adds about 4 percentage points to S&P earnings. So that's bullish for stock investors. And then our biggest theme for the last 2 years has been productivity. We've really hung our hat on productivity improvements, and the investments in AI and the use cases that we're seeing across sectors are exploding. And this new investment for Project Stargate is just one of many I think we'll see that will add to productivity. And if you have higher productivity levels like we did in the 90s, you can tolerate higher interest rates and you can tolerate stickier inflation, which is, I think, what we have, 2 to 3%. So I think it's great for stock investors. You saw the market rally somewhat. I think that's important, and we'll just continue to watch.
We certainly will. Nancy, great point in terms of the fact check there that we are not at a record when it comes to inflation historically. Matt, I want to go to you because you actually worked to implement the Inflation Reduction Act. We heard Trump talking about that. We also heard him talking about really this urging of OPEC to lower oil prices. What stands out to you in terms of the impact on energy and policy more broadly?
Yeah, thanks. Well, I think on the attempt to kind of push OPEC to lower prices, I think to some degree, Trump should be careful what he wishes for. I think with oil in the $70 a barrel range, that's a level that policymakers have historically seen as being pretty reasonable. And if he tries to push that down further, then you're going to see knock-on effects on investment, and maybe ultimately running counter to his goal of greater domestic energy independence. I also think Trump, out of the gate, he definitely signaled that he wants to kind of rein in some of the green-oriented, climate-oriented investments that Biden was making. But in this environment where there's just so much new demand for electricity coming from AI and other uses, I do think in the end, Trump may realize that he needs to go for an all-of-the-above strategy and can't exactly kneecap sources like solar that are adding a huge amount of energy supply to the grid.
Jose, you think about exactly economically what type of playthrough, what type of follow-through we could see if we are, as Trump said within his own commentary, he said that if you don't make your products in America, then in essence, you're going to see tariffs come forward. What type of pass-through would you be looking for in that front?
Well, Brett, I'm looking for acquiescence from trade partners, peace, and continued collaboration from a trade perspective. about a third of S&P 500 revenues come from foreign lands. And some of our competitors, namely the EU and China, have sluggish economies right now. So if the trade rhetoric really heats up, those economies can get closer to a downturn and then affect our S&P 500 constituents here. So I'm a little worried about that. As far as a regulatory regime, lighter regulations here stateside, I think that's great. And what he pointed to with Europe over-regulating and overwhelming their economy, they've totally hampered economic activity. They've reduced entrepreneurship. They've incrementally destroyed their incentive system. And now they're essentially off of the major world stage in terms of U.S. versus China, right? They're not as big of a player as they were in the past. As far as lower taxation, I think that's also a boost to sentiment and to the bottom line. And I think it's a great time for American business, free market capitalism, and U.S. equity investors.
Nancy, let's go to you then to talk equities and stock positioning specifically. I'm fascinated in the moves we're seeing right now in big tech. Obviously a rally off the back of Trump's comments, but still some pressure on individual names. And it makes me wonder how some of Trump's policies, for example, what he talked about with regards to meeting the demands of AI energy needs with new forms of energy, how does that change your thesis on positioning and what your positioning within tech might look like this year?
Well, thanks for that question. I think it's important that investors step away from the rhetoric that we hear on financial news media from my colleagues and fellow investors. I've heard that the tech trade is over for the last 3 years, and it's not. This is analogous to the 1990s. The technologies that we are embracing in this environment are much more powerful than just eyeballs on the internet, which was the 1990s. So I think you want to stay long the tech names that are supplying the infrastructure. So not just chips, but software. One of our 5 for 25 stocks is ServiceNow, which is sort of think of it as the conductor on the internet. I'm sorry, not on the internet, on cloud computing, generative AI computing. And so this is a name that I think you can own for a very long time, growing 20 to 23%. Another name in our 5 for 25 is Spotify, which is, a company that is benefiting from utilizing generative AI in their advertising, but also is a staple for many Americans. And you can look around at old economy companies that are embracing the new technologies. We've talked about this before, but Walmart is the poster child for that. Robotics, generative AI, cloud computing, digitization, and that is driving margins. So I think those are the things you want to focus on as an investor. And then lastly, another one of our 5 for 25 is Goldman Sachs. I think you'll see a release of the M&A tension that we felt over the last few years, and you'll see that business growing very dramatically for all the major money centers, but in particular Goldman Sachs.
Matthew, I want to go similar question to you with the addition of, it seems like from what we've heard or continued to hear to Nancy's point, technology kind of feels a little bit like the new defensive play, especially if there is uncertainty that is going to come forward on the policy front. And we're hearing from Trump that there's going to be this combination of a need to unlock more energy, plus that energy supplying what is thrust forward so much attention towards technology, which is generative AI. I want to play this quick clip that we got from Trump's comments and then get your reaction on the other side of what are the other areas, the sectors that could benefit as well here.
We need double the energy we currently have in the United States. Can you imagine? For AI to really be as big as we want to have it, because it's it'll be very competitive with China and others. So I'm going to give emergency declarations so that they can start building them almost immediately.
You hear a comment like that, what's the strategy that immediately comes to your mind afterwards?
Yeah, well, look, I think Trump is clearly here trying to give a green light to natural gas. I mean, you've seen that in some of the early moves around kind of starting to roll back some of Biden's EPA regulations that I think on the margins were making it a bit harder to build new gas plants in the United States. So clearly, I think natural gas is the sort of top winner here. But I would also say don't sleep on solar. I think if you look at our sort of capacity additions as a country going back the last several years, solar has been a massive contributor to that. And I think that will continue, especially as you see battery storage technology ramping up. And so I would say if some of these solar names are kind of getting caught up in the negative sentiment around renewables and clean energy and Green New Deal more broadly, there may be buying opportunities there as well.
Matt, I want to start to wrap our conversation with you and talk about corporate tax cuts, which of course came up in Trump's Q&A with Bank of America CEO Brian Moynihan. He talked about lowering the corporate tax rate to 15% for companies who are making products in the United States. How likely should investors be pricing in the potential of that to come to fruition, given that Trump does have such a slim majority in Congress?
Yeah, it's a great question. I think in many ways it's probably the biggest kind of macro question that's kind of hanging over markets right now, which is what's going to happen with the tax plan? How is that going to flow through the through to the deficit, in turn to the 10-year yield, and then how is that going to affect stocks? I think when they sort of get down and put pen to paper in Congress, they are going to realize that the amount of fiscal space to sort of do more deficit finance tax cuts is quite limited. I do think the priority will be on kind of preserving what's already in place. You heard Trump talk about the bonus depreciation. I think that'll be a top priority. When it comes to incremental new tax cuts, I think the budgetary consideration there will be quite constraining. And so I do think in the end you will see something in an attempt to kind of lower corporate tax rates, but it will be very tailored, very targeted to a certain set of manufacturing and domestic production activities that Trump is trying to promote.
Jose, like we were talking about earlier with regard to how Trump is framing the economy that he inherited, which let's remind folks, everyone has essentially said that there isn't an economic emergency in some broad scale that we're saying. Sure, there are pockets of weakness, of course, but as we're thinking through where we might see and when we might see the narrative shift, what's going to need to take place in order for that to actually recognize that the economy is still on pretty good footing right now?
Sure, I think, part of it is politics, and the economy is on good footing. I think that to the extent that's a cycle, we can see somewhat of a reacceleration. I think that'll be a win for the Trump administration. Back in 2017, we did see economic growth begin to accelerate. And one area that hasn't participated much from 2021 to late 2024 has been small businesses. And like President Trump mentioned in his remarks, small business optimism ticked up significantly following his victory in November. So, I think those are some of the aspects that are going to start to improve, and we're going to have more broad and diverse growth across the country, in the middle of the country, not just isolated to the gateway cities. In fact, today's market performance, we're seeing that those domestically oriented areas of the market, like the Russell, like the Dow, are tending to do a little better today. Those areas are more levered to domestic policy, like lighter tax rates, like a more relaxed regulatory regime. And I think that's really where the growth is going to come from. Technology is going to remain the top driver, I think. But I think the small caps, the industrials, the energy, utilities, some of those areas are going to be more buoyant in the medium term.
Nancy Tengler of Laffer Tengler, Jose Torres of Interactive Brokers, and Matthew Axe of Evercore ISI. Thanks so much for taking the time.
Thank you.
Appreciate it. We are joined now on the phone by Yahoo Finance's executive editor, Brian Sazi. He's live on the ground in Davos. Brian, we were saying within our Slack channel that we would love to be a fly on the wall or just have a camera in the room, getting some type of eyes on what the reactions were. You were in there. What were you seeing?
Well, lucky for you, Mr. Smith, I was that fly on the wall, and this was very much a packed house here in the Congress Hall. And for folks that are not familiar with Congress Hall is the main center in the bigger Congress Center where they do the most important and the biggest speeches. So I'm not surprised that this one took place there. Packed house. I actually sat next to a couple well-known CEOs, and it was interesting to hear a lot of laughter in the audience. So I would say a lot of rhetoric that is very classic and vintage Trump. So I would say maybe 7 or 8 times a lot of laughter in that room to some of the things he was saying. But here's what stood out to me. And, all week at Davos, we've been ingesting a lot of optimism, hope from banking executives, hope for stock prices. But I just want to remind investors out there at the other side of this coin, we saw a president that came on today and threw a curveball, I would argue, at the European Union talking about tariffs. Now, he didn't mentioned the word tariff when he talked about China and President Xi. So just a small nuance there. Lots of focus on the U.S. hitting potentially China with tariffs. That investors may want to start thinking about what the hell does it mean if the U.S. hits the European Union with tariffs. A lot of big businesses, of course, that the U.S. has also operate in Europe. And then I would also add, too, a lot of focus, too, a lot of CEOs that I caught up with after the event were really keyed in on what Trump said about that tax rate, like you guys have been discussing, taking on 15% from 21%. So that, of course, is top of mind. And then last but not least, I think what you came away from this is it's going to be an unpredictable, of course, 4 years under President Trump and his administration. Nobody in that room, I would argue, thought he was going to come out and call the European very bad or say that the U.S. is treated very badly by Europe. So again, lots of curveballs there. Not everything is rosy. And it's always good to think about the other side of the coin, guys.
Yeah, Sazi, thanks so much for giving us some of that insights. They say the markets don't like uncertainty, but the S&P 500 still within a stone's throw of an intraday all-time high here. That's it for Yahoo Finance's special coverage of President Trump's virtual address to Davos. For those watching online or on one of our linear partners, you'll be joining our previously scheduled episode of Opening Bid already in progress.